I mean, it's pretty incredible to think, of what's happening in the Middle East and the fact that the market has barely taken notice. Maybe there's a bit of move on the oil price, but there's attacks, there are drones, there's Houthis, there's Yemen, there's Ukraine. We also don't know who becomes the next president of the United States. Like, how do you deal with all of these unknowns?
It's hard. I think the overall story is that we've moved towards a much more fragmented geopolitical system, therefore a much more fragmented global economy that is organized in a sense in blocks. That means a loss of efficiency, that means higher cost, and probably means, on balance, a lower potential growth rate for the global economy. Now, the focus has to be on maintaining the conflicts and where possible to try to solve them or stabilize them. In a sense, the good news is that a lot of these things are man-made. Demographics, there's not much we can do about it. That lowers potential growth. Fragmentation, in a sense, we can address. We could find a way to stabilize the situation in the Middle East. We could find a way to ultimately move towards some sort of ceasefire discussion in Ukraine. And we can, we could stabilize relations between the U.S. and China. So a lot of this, in a sense, has been man-made in recent years. It's a problem. It weighs on markets. It weighs on the global economy. And hopefully discussions like this can be a contribution towards lessening these tensions and moving back towards something that is a little less fragmented than what we currently have.
Is that likely?
Well, it's, that's, I suppose at some level, the simple answer would be not really when you look at the current state of play. On the other hand, the cost of this fragmented system over time, I think, is going to drive political leaders and political system towards trying to address those things that we can address. Some things we can't. Demographics, there's not much we can do about it. We can hope that perhaps productivity can be boosted, whether it's through AI or other means to make up for some of it, but there's not much we can do about it. On the fragmented state of the global economy, in principle, these are things that can be addressed through good policy making.
What does a second-term President Trump mean for the world economy?
Well, this is Christine Lagarde talked about it the other day. I think you're going to see her later on today. Certainly from a European perspective, from a kind of globalist, Atlanticist perspective, it's, of course, a great concern. We've been there before. We've survived it, so we'll see what it means. I think the question overall will be, does it lead to even more fragmentation in the global economy? And, if that's the case, the cost of that will become quite apparent.
BlackRock Vice Chair Philip Hildebrand speaking to Bloomberg at Davos. To corporate news, Apple is offering a rare discount. It's as much as $70 on its latest iPhone, but that's only if you're in China. That's the first time they're doing that in years, and it is deepening fears of dwindling demand. Joining us now is Bloomberg's Aggie Cantrill. Aggie, we've seen analyst note after analyst note, maybe about 3 of them so far to start this year, worried about Apple. And the concern seems to be about China specifically. What does this news do, probably to not do anything to ease that concern?
Yes, Danny. So Apple's really known as a company that for a long time has really been able to drive its own pricing power, in the sense that, especially for its most up-to-date products, its latest products, especially in the iPhone part of the business, they really have been able to commit to these very high prices, and people still come and buy them. And so what we're seeing basically in China is a twofold issue. One, which is about competition from the local market. A lot of Chinese people are looking to buy domestic brands, like, for instance, the new Huawei phones, and also a fear around limiting who can use these iPhones in China. There's a fear around people who work in certain sectors not being able to use these products from the US, and that's also a concern for the company. So this is a discount that is happening on some of its latest products, on some of its newer iPhones, just ahead of the very important Lunar New Year holiday in China. Of course, there are other discounts that Apple has put up every year, but to put a discount on its latest iPhone products is really significant.
It is, and again, we saw Apple trade so high at a record to end the year. It's quite the turnaround in sentiment. Aggie, elsewhere in tech, and specifically Chinese tech, Baidu got hammered today, ending the day lower by about 11.5%. Now, the company said it had no knowledge of this reported partnership with a university that is affiliated with cyber warfare. The research, of course, was done for the PLA and the company's AI chatbot. So it's fighting back against this report coming out. Yet the drop is so severe. Is Baidu now about to be caught in the crosshairs of geopolitics?
Yes, Danny, I thought this story was really interesting for the fact that although Baidu had really pushed back on this, saying that they had no knowledge of this research being used in that way, and that they said that if they were using any of Baidu's AI product, it would be what is publicly available. At the same time, this still had such an impact on the share price because of this huge fear that companies that are known to be using, providing AI for potential military purposes could essentially be at risk of sanctions from the US. And that's a real fear for a lot of people who trade Chinese tech. And this has never been much more apparent than what happened with Baidu today. Something that was really interesting that I saw in one of our pieces of reporting on this story is that one of the people they were talking to said that people sell first no matter whether this is true or not.
Wow, yeah, that is definitely telling and again reflected in that share action. Aggie, thank you so much. That's Bloomberg's Aggie Cantrill. That does it for me. Coming up, Kriti will take you to the World Economic Forum in Davos. There's an interview with Joachim Nagel, the Bundesbank governor.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to Bloomberg Markets. I'm Kriti Gupta. European stocks falling as traders weigh the outlook for monetary policy ahead of slew of speeches by policymakers at the World Economic Forum in Davos this week. Plus, Taiwan elects a U.S.-friendly president defying China's warnings. And, of course, we're going to take you live to Davos for interviews with Joaquin Nagel, Bundesbank Governor, and Andrew Forrest, Fortescue founder and chairman. All of that coming up this hour. But I want to get a quick check on these markets because at the first, when we kind of kick off the conversation, well, it's kind of closed for MLK Day in the United States. But European markets very much alive and trading. And I think really picking up on some of that trading volume that we're probably missing in the first two-ish weeks of the year. Bloomberg's Marcus Ashworth has been waiting very, very patiently in the sidelines, waiting for all that trading volume to pick up so he can opine on it. Marcus, a pleasure to have you on the program this morning. Marcus is great because he always asks about just all of the kind of contrarian calls. He's had a lot of different kind of takes on that at the moment. But I'm very, very curious about the contrarian take you think the market is missing right now.
Well, I think that they're being jawboned by central bank officials from the Fed carefully and also clearly the European Central Bank that interest rate cuts are not on the agenda for the foreseeable future. And I think markets have had to sort of digest that after obviously huge rallies in equities, bonds, everything up to the end of the year, that sort of early doors correction to markets where the substantial sell-off, but enough to allow great volumes indeed in new issue markets, both for governments and corporates. There's clearly investor appetite to believe in rate cuts over the course of 2024. Just central bankers want to persuade everyone that it isn't going to happen until well into the summer. That's the battle at the moment. My contrarian view, if you like, is that I think the market's right. I think central bankers are trying their best to hold back the tides, but they will fail ultimately.
Former trader Marcus Ashworth says the markets are right in this instance. Talk to us a little bit about these 5 rate cuts that are priced into the market, because you talk about this appetite for some of this new issuance. I'm curious at what point you start to see the cracks emerge in the liquidity picture here. That seemed to be a big concern in 2023. Did that kind of follow us into the new year?
Well, no, and I think it's really weird. Everyone says, there was a crazy rally into the back end of last year, but I think what I thought was even crazier was the huge sell-off we got on in the summer into the autumn, which made no sense to me, particularly with geopolitical events. And yes, there were some worries about the term premium, whatever that means, and indeed about upcoming supply, which is huge across all governments. Don't get me wrong. For corporates, I think the big question is more in 25 and 26 when they've got a refinancing needs doing. But certainly there is a lot more supply to come. But if interest rates come down, which I believe they will, because I think inflation is falling everywhere, it may take a little breather this next month in the data. But by April, certainly in the UK, and I think showing up also in Europe, we will see back to not possibly even below official 2% inflation targets. So, it's going to be set, the pace can be set by the Fed. I think they will cut, maybe not March, but I certainly think by April, May, there will be a first Fed rate cut that'll set everyone else on the same channel. So I expect bond markets and possibly equity markets to take some great benefit from that. But, as far as liquidity is concerned, I think at the moment we're seeing investors very happy to strap on interest rate risk and get duration and take credit risk all at the same time as we've had yields back up a bit in the last few weeks of this year, so the first few weeks of this year. So that, in that sense, gives me confidence that for the moment, there are no real clouds on the horizon to stop new deals coming and getting taken down, hopefully very well. There will be some indigestion at some point, but I think that's probably more February's trade.
Marcus, talk to us about the FX trade here, because at the end of 2023, and I would argue the first week of 2024, dollar weakness was driving the euro and the pound to levels I think fairly say aren't representative of the strength of their relative economy. When do we see that unwind?
Well, it's all about the dollar, and I think we have to take a view that we know both Europe and we saw German GDP negative 0.3 in the fourth quarter. We may get a flat to -1 in the UK. Clearly the word flatlining is very apposite for everything in Europe and UK wise. And indeed, I see the US growth might temper a bit. But, at the moment, I think, realistically, we've got a fairly clear outlook for growth, steadying, and hopefully should recover a bit at the back end of the year. So I'm not too worried about that just yet.
But what changes that argument? If rate cuts and these interest rate differentials are what's kind of driving this dollar weakness that you say is ultimately going to shake out by the end of the year, where in the election, what flips it on its head?
Well, that's the one trade you want to get right. If you get the dollar right, you'll get everything else pretty much won't matter too much. And I think oil is as good an indication as any. I think dollar weakness will come back. Certainly the Fed makes that move, as I mentioned, by the spring. I think dollar weakness will be the trend for the year. But it isn't going to go easy, and clearly central banks are determined to keep the fight up against inflation. Dollar weakness will be the key test for all markets. Generally speaking, if the dollar weakens, it's best for everyone. That includes the U.S. Markets and economy, but particularly for emerging markets, clearly for Europe and in Japan. So in that sense, that's the least weak pain trade. So we know markets like to find pain, so it's making it hard for us at the moment. But I think the dollar will could strengthen a bit from here for sure, but I don't think it'll be lasting for more than a few weeks.
Who in this market is a glutton for punishment? Marcus Ashworth of Bloomberg Opinion, we thank you so much for bringing that into some crucial context for us. And he's talking about the dollar there and kind of that being the one trade you have to get right. But at its core, you have to get that economic call right as well. Someone who I'm sure can get that call right. Chris Watling, founder, CEO, and chief market strategist over at Longview Economics, joins me here. Let's start with your dollar call.
Our dollar call, yeah. Well, what a great question. I mean, I would actually take it one step back. You know, the idea you've got to get the dollar call right is correct, but I'd say you've actually got to get the risk call right, which is essentially, and that spreads into all asset classes, whether it's the dollar or equities or whatever. And I think it's risk on still at the moment. It's quite interesting if you look at equity markets in terms of a good risk barometer. They've been flatlining for 4 weeks, and there's a big debate out there. Are they going to break out to the upside or downside? Our view is certainly they'll break out to the upside. But yeah, the dollar's tricky. I suspect there's some more weakness in it near term. At some stage, we might have a bit of a growth wobble in the States that might add a bit of risk off and a bit of dollar strength. But yeah, I mean, it is a tricky call at the moment.
Where does that growth wobble come from, though?
I think it comes from the fact that, I don't think you're going to get a recession in the US this year, but there are issues with growth. There was a lot of growth drivers, impetus in 2023, some of the fiscal stimulus, and some of that fades. And also the consumers, all that excess cash has run down, all that kind of stuff. The labour market's a bit soft. So all of that kind of potentially sets you up for a bit of a growth surprise to the downside.
When you're talking about this growth surprise, though, it's coming hand in hand with a year of election. I'm curious from your perspective if it's too early to price in an outcome.
In terms of the election, well, I mean, I think it's going to be interesting what happens in Iowa today, isn't it? Whether Nikki Haley can actually get some momentum and take that forward into the next. It's not Carolina, isn't it? There's another one before
New Hampshire.
New Hampshire. That's it. Sorry. And whether actually she can make a dent. It seems like a long shot, but if she can make a dent on Trump, you never know. And that makes the actual election more interesting at the end of the year, because at the moment, it doesn't look terribly interesting for markets because it looks like Trump's going to win if it's against Biden.
But what difference does Nikki Haley make in that regard?
Well, it just brings huge amounts of uncertainty, I think. A new candidate, a bit more moderate, can take more of the vote from Biden in the centre. So it just makes the whole thing more up in the air, I'm not entirely sure of exactly what all her policies are, but I suspect she's less fiscally loose than Trump, which I think is quite interesting because Trump seems to want to spend everything that's ever existed in America on fiscal policy, which I think is very dangerous at this time.
But from the view of an international investor looking into the United States about whether or not you want exposure during what's expected to be a year of volatility, both on the fiscal front and the monetary front, what is the game changer for you? Are you concerned about the fiscal deficit levels? Are you concerned about trade policy? Or are we still talking at its core about consumer resilience?
Do you know what I'm really interested in is whether or not we're going to get what I call the sort of great global sector leadership switch.
Okay.
Is it finally going to be a year when tech doesn't drive everything? Because, of course, that was exactly what 2023
In favor
was.
of what?
Well, I think we're going to switch away from U.S. equities. We're going to get non-U.S. equity leadership. I think we're going to value. It's very interesting to me how the banks have been behaving in so far this year. The Italian banks have been breaking out to the upside. Japan's breaking aggressively out to the upside. These are really interesting signs that money's going to these places. And tech this year has been kind of mixed. We can get excited about NVIDIA or a bit depressed about Apple, and everything else is sort of in between. So yeah, I think it's, for me, when I'm thinking about the States, that's actually that and the Fed and whether or not they cut and growth and all these things are critical.
Well, let's build on that banks call in particular. If we're talking about this non-sector, non-U.S. leadership, and specifically in banks, well, monetary policy has been driving the bank story here in Europe, but also, I would argue, in Japan as well, on the expectation that at some point the BOJ will give way to some sort of increase in interest rates. But how much more can banks really milk out of that at a time when people are saying if the Fed is going to cut rates, the ECB might beat them to it?
Well, in Japan and in the rest of the world, this is great news. If we can start steepening up the yield curve at a time when there's so many banks are so cheap. My favorite chart of last year and the beginning of this year is if you do a PE ratio of Microsoft versus Lloyds Bank. Lloyds is on 6 times forward earnings, Microsoft's on about 30. And that's the most extreme it's ever been. It's sort of similar to what it was in March 2000.
Yeah.
So who's going to double their PE ratio in the next few years? Now, I know we've got earnings, but my point is banks are really, really cheap.
But critics of that would say perhaps too cheap, and that if you were to measure tech on their valuations alone, you'd be missing out on the great investments of Meta or NVIDIA, or you have it.
Some of them have got great earnings growth. They're great companies, but it's like Charlie Munger said, price is what you pay, value is what you get. So, the sector on 30 odd, they're all on sort of 20 to 35 times or whatever. I think one or two is a bit cheaper, but they're reasonably priced relative to the rest of the market. Or put it another way, 7 stocks are 20% of global market cap almost. They're overpriced relative to global profits. That would be my point. And we need to redistribute that market cap.
So in your view, what is the market missing right now outside of the banks? What's dislocation are you most wary of?
Well, I think the oil price is going to be really interesting in 2024. It's been under quite a bit of pressure, quite volatile this year. It's obviously sold off, I think, since September, and it had a high. But actually, the fundamentals are coming into line. OPEC have cut a lot of supply. There's not much investment. So I think there's, in energy stocks, where there's a lack of supply and a lack of oil capex, a lack of oil services as well, and also in the oil price itself, there's going to be a very good entry point sometime quite soon.
A really interesting dynamic as we speak. The oil price is dropping about 1%, 77 handle on Brent, 71 handle on NYMEX crude. Chris Watling, we have to leave it there, but we thank you so much for joining us this morning. He, of course, joins us from Longview Economics, giving us a little bit of everything. We really ran the gambit with him, and we hope to have him back again soon. Coming up on the program, we're going to take you to the World Economic Forum in Davos, Switzerland. We're interview with Joachim Nagel, the Bundesbank governor. We're going to talk a little bit about what that ECB policy looks like, whether Chris's call about, European banks actually being undervalued is the right call in an environment where oil-driven inflation and dollar weakness still remain major themes in this market. Of course, our crew is going to be live on the scene and walk us through that crucial conversation. Again, Joachim Nagel, the Bundesbank governor, joining Bloomberg Television very, very shortly. Stick with us. Plenty more analysis and geopolitics ahead. It's slow in the United States, but it is analysis and conversation you still do not want to miss. Stick with us. This is Bloomberg.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The 2024 nominating contests are here, and the candidates are making their cases to voters in Iowa ahead of the caucuses. Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage starts today, only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Kriti Gupta. Joining us now from the World Economic Forum in Davos is Bundesbank Governor Joachim Nagel, alongside Bloomberg's Francine Lacqua. Francine, over to you.
Yeah, Kriti, I am delighted to speak, as you said, to the Bundesbank president. Thank you, Mr. Nagel, for joining us right here. Day one, beautiful view, but let's get straight to business and talk about inflation.
Absolutely.
Has anything of late changed your view on when we could get cuts?
I think, first of all, I believe it's too early to talk about cuts. I think inflation is still high. The December numbers were higher than the November month. This was not a surprise because of the base effects, but nevertheless, what we expect for this year compared to last year, that inflation will be half of the level of last year. This is good news per se, but as I said, inflation is too high. So for me, all the discussions regarding inflation cuts, this comes too early.
So does it mean that the market are pricing it wrong?
So the markets are, from time to time, they're optimistic. They are maybe, from time to time, they're over-optimistic. So it's their view. I have a different view. So I want to see new data that is kicking in. So we will wait for the next governing council meeting, and then we will see.
But, Mr. President, if there's a mismatch between what you see and maybe a majority on the governing council see and the market see, does it make actually the transmission mechanism harder? Does it somehow impede with the kind of work that you're trying to do?
I think it's all about communication. This is what we are doing. I think trying to explain to the markets how we see the world as the governing council. So we addressed it several times that we want to wait for data and we decide from meeting to meeting. And this is still my broad understanding. The latest numbers I saw, the December, I just alluded to these numbers, they are above 3%. So our target is 2%. So this is information. This is something markets should see, this information, and then they can price what they want to price.
So is it safe to assume, because you're so data dependent, that it would have to be that a cut would come when you also have new data, that basically it's on a day with new forecasts or things like this?
I think we do have to wait. I think it's really much too early. So maybe we can wait for the summer break or whatever, but I don't want to speculate. I think this is my understanding here. We should wait for new data, and we are living in a very uncertain world. And we shouldn't forget that 2024 is coming with a lot of challenges, and this will have impact on monetary policy. So I really have to believe that this meeting-to-meeting understanding is the right way to do it.
So, and I know some are expecting, for example, wage bargaining. They want to see that before there's any thought about cutting. Others say, look, it's very unlikely to have second-round effects. Again, when you look at this, and I know maybe for you it's early days, how do you look at wage? Can you give us any steps on how you see this going forward?
I think wage development is a little bit the great unknown. So I think it was unsure last year how things might develop regarding wages, and this is one of the data I would like to see how wages might develop in the Eurozone over the next 12 months. And there is still something that has to do with the high inflation rates we saw at the beginning of last year. So we will see this more or less there's a time lag behind that, and I think we will see more on the wage side. But as I said, again, we have to wait for the data.
Is there anything that you could see that would make you want to cut earlier? I don't know if there's anything that can change your mind, or for the moment.
I think when inflation is coming close to our target, or here close to our 2% target, then maybe I can change my mind. But this is too early. I think my forecast is, or what I see is that we are coming close to our target maybe by mid-2025, but it's a long way to go. And so
how do you view the Fed? I know that this is an unorthodox question, but if the Fed starts cutting aggressively, what does it mean for the ECB?
I think Fed is doing monetary policy for the United States. We are doing monetary policy for the Eurozone. So yes, we are looking what the Fed is doing, but we have our own story, and this is different.
President, how do you see inflation then behaving in the next couple of months, 6-7 months? Is it going to be volatile, or is the trajectory after the December month going to be to the downside?
It looks like that is, as always, dependent on so many aspects. What I see is that inflation might come down over the, let me say, next 6 months. We will see maybe some volatile numbers at the beginning of this year. I think the December number gave us a little bit one of these indications that it could be also something that could happen in the first 3 months of this year. Then it looks like that the trend shows or gives us that indication that inflation might come down. So on average, as I said at the beginning of the interview, we will see half of the inflation on average compared to 2023.
What's your biggest concern in the next 12 months? I know here we talk about trust, we talk about geopolitics. All of this just seems a lot of uncertainty out there.
I think on the monetary policy side, we achieved a lot. We hiked 10 times, so we gave a clear indication in the Eurozone that we are committed to bring inflation down to our target. So all the geopolitical uncertainties, I think this is really bringing volatility to the markets. Also about trust, it's all about trust. I think this is what we're doing here in Davos, working on that to have a better cooperation, achieving trust. I think this is so important for financial markets, and this is the major challenge I see for 2024.
But, so is that also for central banks, that actually it's better to cut a little bit later to make sure that inflation is under control? Do you think that goes to the trust of central banks?
I said this several times. Inflation is a greedy beast, could be a very stubborn phenomenon. So we should be more stubborn on the central bank side, and we should avoid a mistake to cut too early. This was often a mistake that was done in the past, and I don't want to repeat this mistake.
But, so, President, just so I understand, I mean, is it possible that we don't see a cut before the fourth quarter of this year? I mean, would you rule that out?
I don't want to speculate. I wait for the data, so we will see.
What's when you're here? Actually, I know a lot of the talks will be meeting also with chief executives to try and understand, for example, some of the wages, everything that we talk about. I mean, you spend 24 hours out of 24 hours thinking about inflation. What do you think the most important conversation here in Davos will be?
I think one of the advantages of Davos is to talk to so many people. Normally, we are talking just between us. As in the governing council between central banks. I think here I can find so many people from so many different areas, get different information, new insights, and I will take advantage of Davos, and I will find maybe new answers, new ideas, what I think is important. This is my mandate, to bring inflation down and do the best here.
How much do you worry about the German economy?
I think German economy is not the sick man of Europe. So we had a rather weak 2023. So 2024 will not be a brilliant year, but we will see growth is picking up a little bit. So I think Germany has to do its homework. So we have our structural issues, but I believe the German industry has shown a lot of adaptation capacity. So we will do what is necessary, and then I am not so, let me say, skeptical about the German economy.
Okay, thank you so much, sir, for the interview today. That was, of course, Joachim Nagel, the president of the Bundesbank. With that, I'm going to hand it back to you in London.
Francine Lockwood there joining us from Davos, Switzerland, really trying to push for some sort of guidance on whether the ECB is going to be following the Federal Reserve path, or at least what the market is pricing in for the Federal Reserve. Let's not forget, 5 rate cuts priced in for 2024. Economists are saying maybe, just maybe, that is an overdone price forecast. On the other hand, does the ECB stick to what Jay Powell and his colleagues actually say, or do you see them kind of marching to their own tune? One of the criticisms of that is simply that even though you are seeing the Federal Reserve perhaps ready to cut rates, the ECB and the European economy, not to mention the UK economy and over at the BOE, the concerns around cost of living and inflation may actually be even higher right here on this side of the Atlantic. Does that, I should say, then create some sort of divergence from the Federal Reserve? Is Jay Powell then the central banker to the world? That doesn't even get us to the PBOC and the BOJ. That's a conversation for another time. But coming up on the program, Fortescue chairman and founder Andrew Forrest joining us from the World Economic Forum in Davos, Switzerland. An interview with our very own Haslinda Amin in just a few moments. Stick with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. I want to get to a really developing story out in Berlin. Bloomberg's Oliver Crook is live from the scene covering some really interesting protests, but it's a complicated story. Ollie, I want to begin with simply describe the scene. What's happening behind you right now?
That's right, Kriti. This is really the culmination of a protest that's been going on for 8 days now. Really, farmers across Germany taking to the streets, objecting to some of the measures that the Scholz government put into place, which is about relieving some of the tax incentives that the agricultural sector had. Now, the government stepped back on some of that, but it wasn't enough. Pandora's box was open, and so now the farmers, not only around Germany, they have driven here to Berlin, some of them for 5 hours this morning, to park their tractors right in front of the center of German government, right in front of Olaf Scholz and the Bundestag, to really communicate the displeasure with what is going on here. And this is a story that we've been covering since the end of last year when the budget crisis began. This is the reality of what that looks like. When you need to start taking money from different parts of different industries, this is what you get. And so we've had some speeches behind us. Christian Lindner, the finance minister, spoke to the crowd, a really hostile audience for him because they're all standing against this government, which they really feel does not hear what they need.
Ollie, talk to us about what happens next year. What are they actually calling for? What are they demanding? And where does Olaf Scholz stand in all of this?
So really what's interesting about this is that since the government already backtracked on a number of these measures and they reduced the amount of time and how long it would take to come into effect, but it wasn't enough. So really this is seen, I think, to a large degree as an avenue to just air their displeasure with the government. And it is, yes, the farmers, but there's also the truckers here. I've spoken to people from the construction industry. I've spoken to nurses who have also been protesting, but we should also tie this into the economic data that we got today out of Germany, a contraction in Germany last year. In 2023, it is the only sort of developed major economy to have contracted next year, and the outlook doesn't look much better this year. You were expecting slight growth in Germany, about 0.3%, but if you ask Deutsche Bank and Commerzbank, they really expect another year of contraction, which is only going to ramp up pressure on this government, which is really dealing with a very difficult situation economically and increasingly politically.
Talk to us about that increasingly politically. When you're kind of looking at the translation into the rest of Europe, governance with the EU, the relationship there, even with some of the other countries, France, arguably the United States and other bordering nations, not that the United States is bordering, but you know what I mean, some of the allies. Where does this spill through? Where is it most noticeable?
So what's interesting when you look at this protest here, there's not this sort of clear for. This is a protest against. And so you have talked to different people and they have different opinions in terms of kind of politically what the solution is. But certainly something that is communicated and clear is that there is not really a great deal of faith in the sort of institutional system, the mainstream politicians, for actually hearing what they're saying. So, you hear this from everybody on the street here and where this comes to a fore politically is you don't have federal elections in Germany until 2025, but you have state elections in Germany in September in 3 of the states here in East Germany. And if those elections were held today, according to the polling, the AfD would sweep all 3. This is the far-right party in Germany, will sweep all 3 of them, which is really unprecedented in sort of the modern history of Germany. So this is going to have, and you look at the chancellor, who's polling right now an approval rating of 19%, Olaf Scholz. That is the lowest a chancellor has had since 1997 when they started putting out these figures. So again, the read-through politically, we're going to see in the state elections, and again next year at the end when there's going to be a federal election.
Certainly a lot to monitor. Bloomberg's Oliver Crook is on the ground amid a pretty dire background, we have to say. He, of course, will bring us those updates throughout the day on Bloomberg Television. In the meantime, Ollie was talking a lot about what's going on and the distress specifically in Germany. I want to broaden out the conversation, talk about the distress perhaps in the Middle East. Bloomberg's Mark Champion joins us now to talk a little bit about the developments we've gotten from that part. Again, he was talking about the polling numbers in Germany. Let's talk about the polling numbers in the United States right now. Joe Biden's foreign policy numbers and approval rate is dropping as we speak, talking about more and more airstrikes in Yemen. Talk to us about whether or not this is officially a regional escalation.
Yes is the short answer. There is escalation going on. This began in one place, along the borders between Gaza and Israel. It expanded into Gaza, and since then you've had constant skirmishing on the northern border with Lebanon, where Hezbollah has been striking, and Israel has had to empty civilians from the border areas. Then you had the Houthis in Yemen, who kind of piled in, and they have attacked commercial shipping going to the Suez Canal. And you have various other Iranian-backed militias in Iraq and Syria also hitting U.S. interests. So in a sense, yes, we've already seen escalation, but what people are talking about when they say we're worried about escalation or regional war is something much larger. That's if there was an all-out war between Israel and Hezbollah, for example, or if Israel became directly engaged, or the United States, with Iran. And those are, that's a completely different ballgame. So there, and the risks for that happening are increasing. Especially if you listen to the rhetoric currently in Israel, there's a growing belief that something will have to be done about Hezbollah. That what happened in Gaza, where the Hamas hit across the border, killed 1,200 people quite savagely, that they can't risk that happening on the northern border. And there is this buffer zone that should be cleared in southern Lebanon, according to UN resolutions. It isn't, and so there's a good deal of talk now in Israel about clearing that area. So for the Biden administration, it's extremely it's trying to keep this contained, keep it in a box. And so far, it hasn't really escalated into a regional war because neither the U.S. Nor Iran, and for now, nor Israel wanted an all-out conflagration. But, you can see some of the sort of, bumpers being taken away there. So it's a little concerning.
Well, let's talk more about the commercial shipping and the U.S.'s attempt to protect the ships. In response to these airstrikes in Yemen, the Houthi rebels have vowed to continue their attacks, although specifying that they're only attacking ships that are headed for Israel in particular. And yet, when you look at the shipping industry, they are still rerouting around the Cape of Good Hope and really not reinstigating the level of exposure they had to that region that they had before. Talk to us about American credibility in this scenario when they're talking about trying to protect a part of the world that commercial shippers just don't believe is protected.
Yeah, I mean, it's, again, a really difficult position for the Biden administration. They clearly were reluctant to hit the Houthis on land. This has been going on for, about almost 2 months now, where they have interfered with shipping. You've seen, 20-30%, shipping rate decline going through that, that channel. It's very significant in terms, especially the hit to container traffic and what's happened there. But there came a point where the U.S., backed by the UK in particular, but there are other coalition members, felt that they had to hit, and they hit quite hard, actually. And it's somewhere between 100 and 150 cruise missiles, and they hit quite hard. But it's very difficult to wipe out all the capabilities of a militia like the Houthis. They're mobile. They're quite resilient. They've been fighting, Saudi, UAE for years, we're still waiting to see what their response. Rhetorically, they've said, this will not stand. We're going to hit back, and that again implies escalation. It will then require that the U.S. and the UK hit back again. We're still waiting though for the real, whatever the real response of the Houthis is going to be.
You alluded to the fact that the Saudis and the Emiratis have been at this for almost a decade now in terms of kind of carpet bombing Yemen at a time when the civil war there has made it, I think, one if not the worst place to live from a humanitarian standpoint. Talk to us a little bit about the U.S.'s role in Yemen in particular. Remember in 2014, they tried to help install that government with the aids of the Saudis, only for that to be very quickly reversed by the Houthi rebels. What does the future of Yemen actually look like?
Well, I mean, it's very hard to really picture a stable future for Yemen right now. One of the kind of many ironies of what has happened since October the 7th is that the Saudis had essentially reversed their policy. They had decided, okay, we failed in crushing the Houthi movement, and they were in negotiations to try and end the civil war and to find some kind of stable relationship. They did the same with the Iranians. They were trying to calm things down, and that's why when the U.S. and the UK hit, the Saudi response was extremely measured, saying, well, on the one hand, we do need to keep commercial shipping lanes open. On the other hand, we really don't want to see any kind of escalation. So, it's a far cry from, a few years ago when the Saudis were really sort of, pushing hard and trying to get more involvement from the U.S. in hitting the Houthis. Those roles are kind of reversed at this point. But I think the key thing is that, that these major players like the U.S., the UK, Saudi, they're essentially being forced into action by, a militia, far away in Yemen, and they're being left with few choices, and this is how escalation happens. It's not necessarily because countries want to escalate; it's because somehow they find themselves in a position where they can't not act.
And on multiple fronts. We talked a little bit about the Red Sea. We talked about Hezbollah as well, but even the United States and U.S. troops in Syria, U.S. troops in Baghdad, for example, still dealing with these Iranian-backed militias. What is the end game here for Iran? What is the scenario the United States is trying to avoid?
Well, Iran does not, as far as we can tell, is trying to avoid a direct conflict with the U.S. or Israel, which it understands that, it would lose in the sense that it would find a lot of its capabilities destroyed. So that they don't want, but they are at the minimum making the most of the opportunity to further their interests, which are anti-Israel, anti-the U.S., to get the U.S. out of the Middle East, to box Israel in, if not ultimately eliminate it. And they saw an opportunity after October the 7th. And so far, if you were going to be completely objective and, cold-eyed about it, you would have to say they're doing pretty well. They're tying the U.S. up in places it doesn't want to be tied up. They are forcing the U.S. administration into decisions it doesn't want to take. We'll have to see how it plays out. It's a very dangerous game.
I'm going to put you on the spot here in our last minute I have with you. Do you think a different president would heal the rift in the Middle East?
No. At the moment, the alternative president that we have there is the potential is for Donald Trump. That would be a very interesting moment in the sense that Trump was both a friend and ally of Benjamin Netanyahu in Israel and of the Saudis and the UAE and so on. The one thing that he might do differently, I suspect, is to take a more direct line in hitting Iran and inviting that regional war rather than trying to avoid it.
And we know that one of his kind of campaign pieces has been how proud he was of the assassination of Qasem Soleimani over in the Iranian National Guard. And even in recent weeks during on the campaign trail has been very vocal about the leadership in Israel as well. Mark Champion, I could talk to you all day long and learn a ton. We thank you so much for joining the program and walking us through just really the delicate dynamics that are happening in the Middle East, from Iraq to Iran to Saudi Arabia, Yemen, of course, the Red Sea, all coming off of the October 7th attacks between Israel and Gaza. Certainly a topic that's going to be a conversation over at Davos as well. We go there next. Coming up on the program, Fortescue Chairman and founder Andrew Forrest joining us from the World Economic Forum in Davos, Switzerland. It's an interview you don't want to miss. Stick with us. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, First of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. Joining us now from the World Economic Forum in Davos is Fortescue founder and chairman Andrew Forrest, joining Bloomberg's Haslinda Amin. Haslinda, over to you.
Well, let's talk about iron ore. Prices have been easing, and Andrew is the best person to talk about that. Andrew, we know that prices have been sliding somewhat. Yes, we had a gangbuster fourth quarter, but they are sliding right now. And the concern is China. Where do you see prices headed?
So I've been hearing about the concern is China for about 25 years, now 30 years. So I don't actually think the concern is China. What we've had with iron ore is this mega trend, which is completely unchanged. And yes, you get dips and bumps, which makes great news. But the mega trend for iron ore is still firmly in place. You've got accelerating steel consumption, and when steel is made out of green hydrogen, electricity as opposed to coal, then you'll really see steel take off. So I'm excited about the long-term future of iron.
Put a price to iron ore for the end of the year.
I think that's a really good idea. What I know, if I predict a price, or or the best analysts in the world predict a price, what we know for sure is that won't happen.
Just put a price to it, your guess. Come on, Andrew.
The mega trend will stay in place.
You say that China has been a concern for you for the last 20 years, but it is a concern. Look, it is growing at 5%, but there is no momentum, they say, and even China is concerned about its own growth. Surely demand will be impacted.
Okay, so I do remember when China was growing in double digits, and it was tiny, and then it was medium, and it started growing high single digits, and now it's massive, and it's growing at 5%. I know most economies around the world who are nowhere near China's scale would chew off their own arm to get 5% growth. So let's look at it practically. 5% growth is very powerful when you've got that bigger economic base.
Do you see China's demand recovering? I guess that depends on its property sector. Do you see a rebound in the property sector that would boost demand and hence price?
Yeah, look, I kind of look at all the economics, but I also get out to find out. I go and speak to Chinese people. I go walking down the streets of various cities, and I see still the burning ambition in mums and dads to leave their children a better life than they had, in their parents still the satisfaction that they succeeded in doing that. Remember, most people were from the revolution. They came out of a farming sector, now they've gone into industrial and high tech. They're doing super well, yet their ambition is unabated. They want to keep on improving their lifestyles.
But are you expecting a rebound in China property?
So you want to go from macro to minor, that's completely fine. I am expecting a rebound.
When?
But it'll be in the next several months. As a long-term major iron ore player, I'm not remotely concerned about it. I can't be bothered about spikes and drops. What I do concern myself about is what is the long-term future for this commodity? Is it locked into the world? Will it be good for the world? Well, it won't be good for the world unless we send steel green, unless we send iron ore green. But I know we can do that, so it will be long-term megatrend, good for the world.
How are you navigating China and the Chinese market?
Well, just through good relationships, through being a Jack Blunt Australian where we just say exactly what we mean. Everyone in China knows that what I say I mean, who they see is who I am. And look, they appreciate it. It's almost Australian in that sense, even though it's got a very deep and different historical culture. To me, you can be very blunt with all Chinese people and leaders like I can across the world everywhere else.
The biggest risk for China, you think? Because when you take a look at the markets, investors have either pulled fully from the Chinese market or they've cut down their exposure to Chinese assets. What's the biggest risk for China?
Look, I'd say that China is leading the world in many cases about going green. If they pull back on going green, that will be a major risk because their popularity as an investment destination, as a place to buy products from, all helps their economy. Now, as they push to go green, and that's hard, right? Because they've got this massive fossil fuel-driven coal-powered sector still growing, but growing faster than that is their green energy program. So I'd say don't slow up on your green energy program. That's where your future support base will come from.
You've been talking about clean energy. Presumably, you came here in your private jet. Just want to put that clear.
Helicopter.
The big bet is on hydrogen. What if that bet fails? What if you are wrong, along with some of the other people?
So I flew here on a product and a commodity which is very unsustainable called sustainable aviation fuel. It's like any other organic source of so-called sustainable energy. It's good for paper washing, but it's not good for anything else. We need to get into a bulk produced fuel which the whole world can make and consume, which is so much better than fossil fuel because it's democratic. You can make it anywhere. You don't have your supply chains cut off because some nutcase gets hold of a missile or wants to go and invade a country. You can do it everywhere, and that is, of course, green electricity. The instant you get green electricity, you can get green hydrogen. The instant you get green hydrogen, you get green ammonia, and that, for the most hard-to-abate industry in the world, everyone considers is probably bulk, heavy, long-distance shipping. We can even send that green. We've proved it at Fortescue. We're now going to prove it to the global shipping industry.
And when do you scale? How do you scale?
Oh, you're talking to the fastest scaling company I've ever met on Earth, called Fortescue. So Fortescue has brought the technology into existence. It's produced the first green hydrogen ship, which is, of course, green ammonia. What it produces as its waste product is beautiful natural nitrogen, which these trees behind us thrive on. And that ship is totally scalable. We're taking that technology now. My last meeting at Fortescue was with heads of shipping and head of marketing and technology, and they were pushing me to say, let's start placing orders for green ships. And I've said, well, tell me, what is the new build cost compared to the rehab cost, compared to the refit cost? And they've said, well, it's about the same. And okay, so what's the operating cost difference between, say, burning this disgusting fuel, which the fossil fuel sector has to get rid of, otherwise they can't sell their sweet crude. They sell it to shipping because it gets burned out of sight from people like you and me, and we burn it. We've got to get away from that, and it's only a few dollars a tonne, so we know the solution is there.
You have been very vocal about ending fossil fuel in recent months. Who's listening, and do you think the Davos crowd will be listening to you?
I think that self-interest is a really important factor to the so-called Davos crowd, and if you consider your family is important, your children are important, in fact, everyone's child is very important, then you'll only be planning your future through a lens of when will you take your company green. The question which Bloomberg needs to always ask everyone who ever sits in this seat is, when will you stop burning fossil fuel? And if the answer is, this decade, give them a hug. If it's next decade, say, which part? Which part, mate? And they say, early, they say, okay, maybe give them a slap on the back. But if they say, after 2035. So you're ignoring the global climate science and proof, which is out there now, that if we don't switch, we're toasting our kids.
I want to take it back home to Australia. You delayed an investment decision in Queensland because you say that Australia is still struggling with a petrostate status. What really is wrong with Australia?
So, okay,
what is the issue?
What a great
what is
question.
The issue?
What a setup question. I love it. So the issue is that we don't have enough green electricity yet in Australia. So I think, I join the political leaders and say, we've got to do more green energy, we've got to do this, we've got to do that, or I can just get on and do it. So last week we announced 14 gigawatts as part of a 20 gigawatt program. That's circa 50 plus billion dollars to bring in. We announced our commitment to that. We are building out the largest green electricity system which Australia's ever seen, and we're fully committed to it. And that is, someone walking the talk.
Andrew Forrest, always a pleasure. Andrew Forrest, the Fortescue. There you have it, Critty. The question that we must always ask all CEOs who sit in the hot seat, he says.
What's wrong with Australia? I'm adding that to my interview docket. Aslan Amin and Fortescue's Andrew Forrest. We thank you so much for that interview and an interesting context from Davos, Switzerland. Coming up, we have plenty more interviews ahead. Amitabh Chaudhry, CEO of Axis Bank, also joining Aslan Amin from Davos, Switzerland. But before we get to the interview, a quick check on these markets here, because look, it is quiet in the U.S. trading session at the moment. It is MLK Day, so of course the U.S. cash and bond markets are closed, but futures are still alive and well and trading. 48.10 on those contracts at the moment. Stocks Europe down about 0.4% as well. Euro dollar catching a little bit of a boost, but not by that much. 109 on euro dollar. Brent crude trading at a 77 handle, down by about 1.5%. People pulling out of that market as we talk about getting exposure to the Red Sea developments. Plenty more analysis ahead. Stick with us. This is Bloomberg.
Expecting there to be not necessarily a wholesale adoption across the world, but we have many governments that are looking what the EU is doing and are in the process of introducing similar regulations or variants thereof. Then I think it'll be very interesting to see how these global companies will adjust their business practices. Will they implement the obligations of those regulations only with respect to Europe, or whether they do it globally? And sometimes it may be very difficult in today's conversation environment about which is more hostile or more skeptical of the big tech companies. If Facebook, for instance, cannot use targeted advertising, or Instagram cannot use targeted advertising on minors in Europe, can they then justify that they continue that very same practice in the United States and elsewhere? Because there will be many who say, well, you have ceased those activities in Europe. Don't you care about protecting our minors as well? And it is harder for reputational reasons for Facebook, for instance, then to confine its conduct and the changes it will have to make to Europe alone. So I think we will see some ramifications of those regulations outside of Europe as well.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better better place is all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Coming up on the program, European stocks slip as traders weigh that monetary policy outlook, plus some of the economic data. Germany, for example, narrowly escaping recession with fourth quarter GDP contracting in just the slightest. Plus, we're live at the World Economic Forum in Davos, Switzerland. Top issues on the docket include two wars on the global stage, of course, between Israel and Hamas, as well as the war in Ukraine, plus monetary easing and more. Meanwhile, over in the States, U.S. lawmakers release a stopgap spending bill to avert a government shutdown as Iowa Republicans brave frigid temperatures on their way to today's pivotal caucuses. I hear it's negative 33 degrees in Iowa, negative 36, I should say, in Celsius. If you're joining us here from Europe, it's a pretty frigid environment in the markets as well. Stocks Europe 600 down about 0.4%. Futures, of course, we know the cash trading in the United States is closed due to MLK Day. Futures, however, are still trading, however, with very, very light volume. 48.09 on those contracts, down about 0.2%. But you are really seeing the risk sentiment around the world in some of the stock market is really echoing each other. Eurodollar is another one I have my eye on. Look, it looks unchanged at the moment, but it has been moving quite a bit throughout the session. 109 on Eurodollar. One of the big questions right now is, do we start to see a dislocation in the dollar given all these rate cut bets? Is it creating artificial strength in the euro? That's going to be a question going into the next couple of months. Plus Brent crude, no artificial strength there. 76 handle on the commodity, down 1.7%. A lot going on in the markets, although it is closed in the United States. They're very much well and alive here in Europe. Joining us now, Matt Orton, Head of Advisory Solutions and Market Strategy over at Raymond James Investment Management. Matt, a pleasure to have you on this program. Happy MLK Day to you. We appreciate you taking your day off and spending it with us. I want to start right in the center. What is the biggest market dislocation for you that we've kicked off with in this year?
Hey, Kriti, great to see you. And it's nice to have a day off here in the U.S. But I think the biggest dislocation that I'm looking at right now in the market is how do you digest the possible rate cut pricing that the market has put in versus what the Fed is actually going to do? Because we've been here in the past. For really the past year or so, the market's been pretty aggressive at pricing in what it thinks the Fed is going to do. And it's pretty much been offsides in almost every single one of those cases. So, when you look at having such a good rally heading into the end of 2023, the fact that we've kind of flatlined at the start of 24, you've got to ask yourself, have we maybe gone too far too fast with respect to the rate cut pricing? And what's going to lead it to actually materialize if that's the case? And just the recent data, as good as it is to see inflation coming down, the PPI print was good. It's going to feed into PCE, but I don't think that's enough to get the Fed to move in March, let alone have 6 rate cuts happen in 2024. So what I tell clients right now is it's okay to wait and watch the market. Be opportunistic with downside, because I still think earnings are going to be good, and there's still a lot of opportunities in the market to play a broadening market outside of just the Magnificent Seven that really led the market last year.
A lot to chew on there, Matt, and I'm going to take it piece by piece. Let's start with the macroeconomic that you just talked about, the rate cuts that are getting priced into this market. we're looking at about 5 rate cuts priced in at 2024 for the Federal Reserve. But if you compare that to, say, the amount of market moves that the bond investors themselves are creating in terms of the Federal Reserve, you are seeing that bid for the bond market arguably have a more direct effect on the real economy than, say, the market pricing itself, or even the Federal Reserve reacting. How worried should the Fed be about the markets perhaps being in control?
Yeah, I mean, I think that the Fed, I was surprised at how little the Fed in their statement in December actually pushed back against the market pricing, because when you look at financial conditions, we're at the easiest financial conditions from, I think, September of 2022. So we've gone really far up and then really far back in the opposite direction over the course of 12 to 18 months. That's a problem. I think at the end of the day that the Fed has been really good at least anchoring consumer expectations. And really, that's what's most important, is have we kept expectations for inflation anchored? The Fed has done a good job of that. The market's going to react to what the Fed has. I don't think the Fed has lost control of the narrative. I think the market's done this in the past. We will normalize if inflation comes a little bit hotter, but I think there's just some indigestion that we're going to have to go through. And it's one of the reasons, too, Creedy, that there's such a dislocation in the market between rate vol and equity vol. I mean, even though the MOVE index has come down, the ratio between MOVE and VIX is still near all-time highs. So I think we're going to go through a period where that remains the case, and then we'll see what happens on the equity side. But again, if earnings come in fairly strong, I don't think you're going to see that big pickup in equity vol because there's a good base on which you can continue to build.
So it kind of sounds like you're in the camp of consumer resilience really lasting. What's your time frame on that when you look at that earnings strength?
Yeah, the consumer, I've learned over my career, Creedy, to never bet against the American consumer. That's a bet that's really, really hard to win, because we're great at spending money we have, and we're even better at spending money that we don't necessarily have. But I think one of the key pieces of the consumer that was so underappreciated last year was wage growth. Sure, we've gone through all of the stimulus checks. We've exhausted a lot of, or almost all of the pandemic savings that were pent up. But the bottom 50% of the American consumer is making more money, and their real wage growth has been positive for the past almost 12 months at this point. So when you look at the banks, you had JP Morgan, you had Bank of America last week, and you continue to hear from them that the state of the consumer is good. And when you look at bank balances for that bottom 50%, they're still strong. And so those marginal dollars those consumers can put into the economy remain pretty strong. And I don't think that changes. You continue to see pretty good wage growth, especially for the bottom cohorts. It's the top 50% that's a little bit more worrisome. But I think their wallets still remain open. So the story of the American consumer, I think, is still there, at least for the duration of 24. We'll see what happens, where the economy goes, if we still have this more benign economic backdrop heading into next year. But I do think the consumer remains a good enough base to allow equities to continue to expand. But changing tastes do matter. So I've actually been recommending to clients to fade some of these trades around travel and leisure and those sorts of things, because I think the consumer's feeling more constrained, even if they're not actually more constrained.
It's the classic wealth effect working against perhaps some of those stock bulls. But Matt, talk to us a little bit about, you talked about the consumer resilience, the consumer base. Talk to us about the corporate base as well. We are still in an era where a lot of these corporations, even outside of the Magnificent Seven, are still sitting on record piles of cash in an environment where we're still dealing with inflation. Is that a positive or a negative?
I think it's a positive. I think corporate America's never given enough credit for where they are. I mean, last year the calls for earnings apocalypse, just quarter after quarter after quarter, never actually materializing, because companies have been smart. They've made investments, or at least the good companies that you want to own have been making investments over the past 12, 18 months with a lot of the cash that they have. And they used really, really cheap money during 2020, 2021 to finance a lot of those projects. So the the corporate balance sheets themselves are actually in a really good place. And I think, Creedy, what's really underappreciated in the market, and one of the areas that I like the most for this year, are smaller companies. So down market cap, there's been this misconception that smaller companies have balance sheet problems, and that's just not true. A lot of smaller companies also took advantage of cheap money, and when you look at their debt to capitalization ratios, they're just as good as some of the best large cap companies right now. So they're not given credit for that. It's reflected in valuations. I don't think there's a big problem, particularly for higher quality small cap companies on the balance sheet side, so they can keep funding their growth. So the picture looks really positive, especially down market cap.
But funding that growth, and you mentioned 2020 and 2021, that record issuance that got them those kind of cash cushions in the first place. Matt, when do we see the reckoning in the debt market for some of these companies?
So for larger companies on the S&P 500 or so, the biggest part of that issuance, a lot of that debt doesn't come due until at least 2030. So when you look at the maturities over the next, call it 5 years or so, you've got maybe, 5-6% of companies with different debt maturities coming up each one of those years. 40% or so of the debt on the S&P 500 companies is going to come due post 2030. So in the short term, it's not really that big of an issue. So the market worrying about rising rates, the impact it's going to have on corporate balance sheets, sure. Lower quality, junkier companies are going to have problems. They'll have problems funding revolving credit. But by and large, the companies that you want to own moving forward, even in the double B space, there's a lot of really, really good balance sheets that don't have these impending debt cliffs coming up, at least in the near future. So you've got some good runway because you had good balance sheet management taking place over the past few years with just record low interest rates.
Matt Orton of Raymond James, we have to leave it there, but we thank you so much for that analysis. I keep throwing different asset classes at him, and he keeps coming back with an answer. We thank you so much for joining us on this MLK Day from the U.S. And a part of that kind of investment strategy and that investment playbook is going to be how the geopolitics all factor in. We talk a lot about it from the U.S. presidential election, but there's plenty in Europe to keep us busy as well. Bloomberg's Oliver Crook is covering just one of those stories live from Berlin for us. Ollie, set the scene where you are.
That's right, Creedy. This is the 8th day of farmer protests across Germany where they've been blocking roads to really air their grievances with this government. And this is the day that they've all embarked and come right here to Berlin, to the capital city of Germany, to make their displeasure unknown to Chancellor Scholz and the coalition here. So some of them have driven here through the night to park their tractors here. There's a procession over a mile long in this direction. We've just had a number of the associations from the farmers and others speaking at the stage here. And basically all this to do with those budget cuts that we talked about last year, the budget crisis that unfurled here in Germany. And this is really where the rubber hits the road, quite literally, because they had to fill those gaps. And one of the ways that they did that is they pulled some of the tax incentives away from the farmers. And that has unleashed an absolute torrent of protests. And it's mostly the farmers, but you also have truckers. I spoke to some people who were nurses and people in the construction industry. All this to say, and basically with an economic backdrop, as we've been talking about today, Creedy, that is really looking very poor for Germany.
Well, connect those dots for us then, Ollie. We know we've gotten some of that German data as well that suggests the German economy is just chugging along. How does that translate further into the political pressure at the helm of the country?
Well, we say just chugging along because they dodge recession basically barely, right, by a couple of basis points. I mean, we're talking about an economy that is flatlining. It contracted last year. In terms of what it looks like this year, it's not looking a whole lot better. I mean, economists that we survey, they expect a bit of growth in Germany this year in 2024. But you ask Commerzbank and Deutsche Bank, they both see contraction this year. And you fold that into the sort of political scene here. No country likes to get poorer, and certainly not one that is sort of an affluent background in some of these tough decisions. And this is a government and a country that refuses to take out debt to debt finance some of the stimulus, and that's a situation that we're brought to here today. And so it's hard to see the situation improving at all, and it's just that economic pressure is just going to ramp up the political pressure here in Germany.
A history and a legacy of fiscal austerity that may not be working in their favor. Oliver Crook, we thank you so much for your reporting live out of Berlin, as of course he covers the on-the-ground translation of some of the economic perils that various citizens of Germany are facing. And that's going to be a theme from around the world. How do you start to price in some of the inflationary pressures, the wealth gap that various G10 countries in particular are dealing with? Certainly something that's going to be top of the docket for the conversations in Davos, Switzerland. Coming up on the program, Axis Bank Managing Director and CEO Amitabh Chaudhry joins us from the World Economic Forum in Davos, Switzerland. Haslinda Amin has that interview in just a few moments. You do not want to miss it. Stick with us. This is Bloomberg.
To keep rate World Cup. This is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything. The 2024 nominating contests are here, and the candidates are making their cases to voters in Iowa ahead of the caucuses. Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage starts today, only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. Let's head over to the World Economic Forum in Davos, Switzerland. Bloomberg's Haslinda Amin standing by with Amitabh Chaudhry, Axis Bank MD and CEO. Haslinda, over to you.
And Kriti, Axis Bank is one of the biggest private sector banks in India, and Amitabh has been credited for cleaning up the bank. Amitabh, good to have you with us. First off, I want to talk about India. It's going gangbusters. It's become the darling of investors. Can that momentum continue if China gets its act together?
Well, we have been there before, where India has been going gangbusters and we've not done a great job of it. But I think given the current dispensation of the government and how they are embracing this particular opportunity and how they've gone about, from a geopolitical perspective to how they manage the economy, how they opened it up, how they engage with the business partners globally, I think India is definitely much better placed than before to get this right. We have elections coming up in May 2020 this year, and we expect the current government to continue to come back to power. And given all those factors which are aligning in favor of India, it should be helpful for India to really achieve some of the goals and some of the aspirations.
What kind of growth can we see in India?
So if you
sustainable.
Well, people are talking about, our economists are revising the growth to upwards of 7%. Maybe the next year it could come down a little bit depending on how some of the global factors play out. But India has now definitely reached the zone of 6 to 7.5% growth. Can we sustain it? I think, as you rightly said, things are aligning in favor of India. You mentioned China. Yes, China is struggling through. I'm sure the Chinese government will take all the action necessary to ensure that the growth is back. But growth coming back to any part of the world economy is not necessarily bad for India. It is good for India. And ultimately, China is a competition to India. But at the same time, anything which uplifts the global economy is good for all the countries around the world.
What could go wrong for India then?
Well, global turbulence is something which we all worry about. It's unpredictable. Things are happening around the world which no one could have even imagined 6 months back. Any kind of global slowdown will obviously impact our exports. They account for 15% of our GDP. We also have to be aware of the fact that the interest rates in the emerging markets and generally the better economies of the world will remain higher for a long period of time because, for example, US has moved from a very loose fiscal and a tight monetary policy to exactly the opposite. And given what is going on there, we expect the interest rates to remain higher for some period of time. The people are pricing in a Fed cut. India, given its inflation, will keep interest rates higher. And in a high interest rate environment, it does impact economic growth at some stage. So we have to be careful about that. But otherwise, as I said, things are generally lining up for India.
I mean, Indian banks are also doing well now that they've cleaned up their bad loans. Deposits. Such great competition in that space, but you're lagging behind. How are you looking to catch up to your bigger rivals?
So firstly, I don't think we're lagging behind. We'd like to do much better. So in that sense, yes, if you were to say I was lagging behind, yes, we are. But, right now the deposit growth in the country itself has been constrained because RBI is playing a role of, just tightening the whole system a little bit. They need to get the inflation down, and they believe that it is very important for them to have to keep tight rein on the kind of liquidity in the system. All the other three factors which could potentially add to the deposits. The reduction of cash in the system, the reduction of balances which the government has with RBI, which tend to suck deposits out, or the credit growth have been quite robust. So just because of RBI tightening, the deposit growth rate has been muted. I think once RBI can get the inflation down to the range which they have, close to 4%, they're right now at the upper end of the band, I think we will see some rate cuts. Hopefully that will improve liquidity. Hopefully that will bring deposits back. As an institution itself, yes, we have a lot of work to do. We have done a lot of cleaning up. We have reduced our outflow rates by 550 basis points in the last 2 years. But we are right now going through a transformation. We're really trying to build a system and institutionalization of how do we do things on a day-to-day basis in every part of the bank.
You talked about the RBI possibly cutting rates. When do you see that happening?
I don't see it happening this year. Maybe it will happen early part of next year. I think the inflation still needs to come down. The food inflation is still higher than where RBI would like it to be, and so obviously it feeds into a slightly higher inflation story. It is coming under control slowly, gradually, but I don't think we're going to see interest rate cuts this year.
We talked about retail exuberance, consumer exuberance. Is that a cause for concern, and when does it become a red flag for you?
See, any kind of exuberance is not good for a risk-taking business, and we are in the risk-taking business. So in that sense, just this desire to grow could lead to a situation where banks start lending money to every sector, every customer segment, even to segments which are not necessarily creditworthy, and that could lead to the wrong kind of exuberance and lead to loan losses. I think the Reserve Bank, our regulator, is very clearly indicating that they're worried about the exuberance. They've added risk weights to all kinds of loans, which means that the cost of lending has gone up, the capital requirements have gone up, and it's a clear indication to the market that slow down. And RBI is not the only tool which RBI is available to itself. RBI has myriad number of tools which they can use to give an even more clear signal to the market that if you don't bring down the growth rates, we will take further action. So I think they're just trying to see at the credit growth rate and the deposit growth rate, and they're seeing that both ultimately need to converge over a period of time. And in some specific sectors, especially loans to small, up to 50,000 rupees, they're seeing NPL rates which are much higher than expected, and they want to be taken care of.
RBI says slow down, but it is not slowing down. What could be the next move from the RBI?
Well, RBI has taken a step very recently only, so I think you will see the impact of this come through in the results in this particular quarter and the next quarter. I don't think you will see this exuberance continuing at the same level as before. And frankly, if RBI, because RBI is not getting data on a quarterly basis, they're getting data on a daily basis, if they feel that the numbers are not stacking up, they will take action. And as I said, we have a very, very smart, proactive regulator. They have been, if you read what the governor has been saying, and I think he's saying it very openly, you don't even have to read between the lines, I think the message is quite clear.
In terms of M&As for Axis Bank, are there plans in the next 12, 24 months?
Well,
what would make sense?
Well, anything which adds to our deposit franchise, anything which adds to our subsidiaries gaining scale, anything which adds to some of our businesses which have the high, risk-adjusted return on capital, where we could gain scale, does make sense. We have just, completed the Citibank acquisition, which was one of the largest acquisitions in the country. In middle of this year, we will shift from Citibank technology to Axis technology. So in a way, the transaction is not fully done, at least from our perspective and for our customers, who were customers of Citi earlier. So we need to absorb this. We need to get the full benefit out of it. So we will be very, very careful about looking at acquisitions, but never say no and never say never. But I don't see today where I stand that any transaction is going to happen in a hurry.
If the price is right.
Price is right, but right now, look at the equity markets in India. Where is the price right? So in that sense, as I said, I keep to the same statement that I don't think anything is happening.
You've led the bank for 5 years. You have been credited for cleaning up the bank. What do you think is the best achievement for you, and what could you have done better?
So obviously, you talked about the asset quality. That was important. I think another thing which we did when I at least came in was we announced what we call growth, profitability, and sustainability strategy, and we put our put a hand out there and said we'll make 18% ROE. I think we're stuck to that strategy. Our articulation of what we want to do, how we will go about it, has been consistent, and we have built on that over a period of time. And that story is clear internally and externally, which allows our investors and as our employees to be able to relate to something. I think that's the second thing we did. Third, invested in technology a lot. We were slightly behind in technology, so the amount of, we were the first bank to announce a digital banking unit. We are now 2,400 people there. The kind of work they have done is quite incredible. We have the best rated mobile app in the world now. So a lot of work in technology in terms of our architecture, about some of the platforms that we have created, and how we envision the world of digital banking in 3 to 5 years at that time, and how we are continuing to do that as we move forward. Fourth, I think just a dose of aspiration and ambition in our employees. I think somewhere they started thinking that we are good where we are at, and I think at least when I came in, I said, no, I'm not here to remain where we are. I'm here to take it to the next level. And I think just infusing that dose was very, very important. We have done that. I mean, you asked me whether we could do anything better. Everything could be done better. At the end of the day, I'm quite well known in the bank for saying that my job is to look at glass half full, half empty, sorry. And I'll keep looking at that all the time. So I will keep looking at things and saying, what could we do better? And in everything, there's always potential to do better.
Amitabh Chaudhry, we thank you so much for your time today. Great insights there. Kriti, handing back to you. We're coming to you live from Davos.
Haslinda Amin there and Amitabh Chaudhry of Axis Bank, we thank you so much. Of course, having that conversation about whether or not India is that darling of not just the EM world, but potentially the growth story of the entire next couple of decades. Is it the new China? At the end of the day, some really interesting insights there from the CEO of the largest private bank in India. Still ahead, Bill Lee, Executive Director and Chief Economist over at the Milken Institute. Plenty more ahead. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down, right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Some headlines crossing the Bloomberg terminal about just the latest coming out of Boeing. We know they've had not only a rough couple of years, but a rough couple of weeks as well. I want to bring you these headlines here. It looks like the commercial head of aircraft, Stan Deal, commenting in a letter to workers saying that they're opening factories for 737 operators for added oversight, saying that an outside party will review that quality management system and deploy the team to work at Spirit as well for inspections. And to be clear, that Spirit Aerosystems, which is, of course, one of the key suppliers of Boeing, not Spirit Airlines. Boeing also saying that these added inspections is going to help throughout the building process. There's a lot to digest in those comments. I want to bring in Benedict Campbell, who covers global aviation for Bloomberg, joining us with the latest. Benedict, your initial take on these steps that Boeing is taking?
So as you said, we heard from Stan Deal. This was a letter to employees, and it's one in a string of communiques that the company has put forward to employees. There was a town hall about a week ago with Dave Calhoun, the CEO. He was also flanked by senior management for that. And really the sort of overarching theme in all of this is a company, yes, in crisis mode, but also a company that wants to be as transparent and as clear in its messaging as it can. We know of the two crashes that happened almost 5 years ago. If you go back to that and the sort of tiptoey response that was seen by some back in the day, the company's probably learned from that, and they're trying to be open, transparent, put the cards on the table, and that includes opening up to more inspection. As you said when you read those headlines, they're adding another inspection layer to their processes. They're bringing in not only a third party to help them, but also 737 operators, so the likes of United, the likes of Alaska, say Ryanair, all the companies that fly the 737 MAX are being invited to come into Boeing, come into the factories, review the processes. They are crucially deploying a team to Spirit Aero, that's their supplier, to make sure that whatever Spirit does is up to snuff, meets their standards. So really a deep dive into their processes and to sort of sharpen their inspections.
Talk to us about where you actually go from here. I mean, there's only a handful of major players in this space: Boeing, Airbus, maybe a Bombardier if you're feeling lucky. But I'm curious about just the backlogs that are involved with a lot of these jets for customers, for airlines that are worried about a Boeing 737 right now. Do they have any option?
Well, the short answer is they don't have a lot of options. This is a duopoly that has existed for many years and has really solidified around Airbus, around Boeing. And if you are a long-term Airbus customer, you will probably remain a long-term Airbus customer. If you're a Boeing customer, you will stay in that camp. And it's not only just sort of preference and what you're used to. It also has some hard sort of economic reasons. You know, you want what's called fleet commonality. You want to have one fleet, one plane. It minimizes minimizes training, it minimizes inspections, it minimizes maintenance, you know, the cost outlays you might have for simulators, all these things. You don't want too much complexity in your fleets, and the more you mix and match, the more complex it becomes. So traditionally, a lot of airlines have sort of built their fleets around one supplier, be it Airbus or Boeing, and as you say, it's very difficult to make that switch. Even if you wanted to, say you were a Boeing loyalist and said, look, I'm going to have a hard look at what Airbus has, you have to join the back of a very long line at this point. Airbus planes are sold out for many years. In the case of the 320, which is the rival product to the 737, you probably won't get a slot until maybe the end of the decade. So even if you wanted to make the switch, your options are very, very limited, and you need some real patience.
What kind of timeline are we looking at on top of the backlog you just described? These added layers of inspection, what does it do in terms of time frame for actual delivery?
It's too soon to say at this point what it'll do for Boeing, but it's probably fair to say that it will slow things down for the company as a whole. I mean, if you think about what we just heard from Stan Deal, these inspections, that means extra time, and the company at this point is saying this is not about putting commercial interests first, it's about putting the inspections first. Dave Calhoun, the CEO, he was asked in an interview last year where his priorities lie, and he said very clearly that right now the production sort of clip is not really where his focus is. So this will be very interesting and something we'll watch very closely in terms of sort of what the midterm, the longer term fallout of this will be, is what does it mean for their production rate? This was supposed to be a year for Boeing where production really goes up and into next year, and that seems to be one of the risk factors here for them. Will I just have to be slower? These extra inspections will take time, and that also means ultimately having a less profitable business, because you can say about the 737 whatever you want, it was a very profitable program for Boeing, and you know, the fewer planes they deliver, the less money in the bank for them.
Benedict, if we can kind of go back in time here and talk about some of the last kind of iteration of this that Boeing had gone through when it came to the regulatory aspect here from the FAA, but also from other aviation authorities around the world. China was the last to kind of clear the 737 to go back into the air. Do you see or forecast perhaps similar pushback?
Well, we had hoped, or Boeing had hoped, to resume deliveries to China. Remember, ever since the grounding of the 737, China has not taken delivery of any 737 MAXs. And around the end of last year, we were seeing movements up at the factories of Chinese planes with Chinese livery that were moving around on the airfield, that were going on test flights. And there was real optimism in the Boeing camp that deliveries were just around the corner. This was coupled with sort of the thawing of political relations, and there was a general sense that Boeing had managed to get over that final hump, that now sort of life in terms of their relationship with China was back to normal, that things were resuming, and now there's a huge question mark over that. There was a story out this morning that said that China is probably slowing things down again. The whole sort of overarching theme is here of a great slowdown for Boeing in terms of the regulatory response, in terms of the Boeing build rate, but also with the Chinese. They're probably using this as an opportunity to say, well, hang on, not so fast. We want to make sure that the planes that you are delivering are, you know, that they meet our specifications. And if anything, they might use it as a way, as a sort of political tool where they can say, sure, we'll take these planes, but we'll want some concessions off the back of that. So all of these things probably coming together in a slightly unhealthy cocktail for Boeing, but it does ultimately mean that also on this front, there will be something of a slowdown.
A really interesting dynamic with Boeing that leaves a lot of these airlines with very limited choice. Benedict Campbell, we thank you so much for your insight and reporting on this issue. I do want to stick with that China theme, though, and bring in Bill Lee, chief economist over at the Milken Institute. Bill, good morning from London. We're talking a lot about the dynamic with China right now, not only in regards to corporations, American corporations, whether it's the Magnificent Seven or Boeing, but also in light of the presidential election we just had in Taiwan as well. Bill, are we in for another trade war between the two largest global economies?
Well, we would have thought that if because the Democratic Party got reelected and they're going to continue their independence line. But one thing to keep in mind is that the Democratic Party, DPP, lost control over the legislature. That means that they're not going to be able to form a coalition government without having to compromise some of their more extreme views and make a deal either with the Kuomintang or some of the other minority parties in order to get their legislative program through. And that means, I think, that the tensions will be eased up a bit because they're going to have to consider more domestic policies, and also in order to make that deal with Kuomintang, they're going to have to temper their independence views.
Well, Bill, let's build on that and talk a little bit about what that trigger point might actually be. If we're kind of breathing a sigh of relief on the Taiwan front at the moment, of course, we're in 2024. We have a presidential election in the United States as well. What kind of tipping point are we looking at where tensions might re-escalate?
That's a great point, because even though the tensions in domestic politics in Taiwan have eased up a bit, as we go into our election cycle, the one area that everyone agrees with is that we have to be careful about China. The both Democratic Party and the Republican Party are going to be very, very aggressive in trying to protect U.S. interests, and in particular to diversify supply chains in order to get around the fact that China has been the center of manufacturing for the world and the supply chain center for the world. In order to get more votes and in order to get more comfort with safety of global supply chains, there's going to be much more talk about friendshoring and reshoring and really diversifying where it is that we get all of our production, not just of electronics, but pharmaceuticals and a lot of other things that have been centered around China.
Bill, is this only an economic war, though? I'm curious because I read some analysis coming out of the Defense Department, actually, that said that the least funded part of the entire American defense system is actually in Pacific Command. Are escalations, military escalations between China and the United States, even on your docket?
Oh, in fact, unfortunately, it's not on the docket of the financial markets. The financial markets have been completely focused on the pace of rate cuts. And I think they've ignored the fact that there are good cuts and bad cuts. And the bad cuts are the ones that deal with the economy falling apart and the Fed having to lower rates in order to bolster a faltering economy. And the source of that would be the supply side. That is, if there's any disruption in the supply chains, and we already see that in the Houthi attacks on the Red Sea and possibly with the Taiwan Straits, the fact that we haven't funded for those sorts of conflicts is something that the markets have not priced in yet. And you're absolutely right to point out that the vulnerability, if there's ever going to be a big shock in 2024, it's going to come from other theaters. Regional conflicts that become global would be the big systemic risk that markets have totally underpriced.
But is that something that is worth pricing in, Bill, at a time when we're smack in the middle of the Iowa caucus at the moment? We are kicking off that presidential cycle, and a foregone conclusion, whether right or wrong, is that ultimately in November it'll be a question of Donald Trump or President Biden. At least that's the consensus at the moment. Is that something that the economy, market strategists should be thinking about, should be pricing in, the idea of a Trump 2.0?
Well, U.S. political risks, whether it's Trump 2.0 or some Democratic 2.0, whether it's Biden or not Biden, as I said before, the consensus is that they're going to have to deal with China. And that's a rubric around which we can talk about funding defenses for unanticipated events. And the big unanticipated events is really conflicts that are now considered contained and regional becoming much more systemic. When we had Ukraine break out, it became a global concern because it interfered with energy prices, interfered with food prices. But then we saw that it was relatively contained to Europe, a European problem, because U.S. production of petrochemicals had been so strong that we were able to really survive that kind of oil shock. What we don't have now is a defense against Houthi attacks, which really threaten a lot of global trade that goes through the Red Sea, which includes energy and manufacturing.
Could those risks in the South China Sea as well as the Red Sea actually re-hype up inflation at a time when people are saying it's a one-way path down?
The reason why we think it's a one-way path down is that supply chains have become repaired. We are able to get stuff that we couldn't get during the COVID area. Now, if once we cut off the Red Sea as a huge transportation route, pricing of the stuff we import from the Middle East and Asia is going to skyrocket, and that will re-manifest the problems that we had during COVID, and that's the sort of stagflation problem that we wanted to avoid, and again, a source of bad rate cuts. If the Fed and global central banks were forced to lower rates because we enter a period of stagflation, that would be a terrible consequence.
5 rate cuts priced in for 2024, and that doesn't even include the pricing related to the geopolitics. Bill Lee of the Milken Institute, we thank you so much for your analysis this morning. Of course, right off the back of that crucial presidential election in Taiwan. What does that mean then for the United States? But it's not the only election we're watching. We are officially in the swing of 2024's presidential election in the United States. Kicking it off with the Iowa caucus, Greg Vallier of AGF Investments joining us for his insight on the Iowa caucuses. Stick with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space. And we need investment support because we are the best investment cases for this in the world.
This is Bloomberg.
Welcome back to Bloomberg Markets. I'm Kriti Gupta in London. We're watching very closely what the repercussions of the Iowa caucus are going to be from around the world. I want to get a little bit more insight here. Greg Vallier, Chief U.S. Policy Strategist over at AGF Investments. Greg, a pleasure to have you on this morning, and especially on MLK Day, of course, where the U.S. markets are closed. We appreciate you making the time. Let's start with these Iowa caucuses. How relevant are they?
Well, I'd be a contrarian and say they're not incredibly relevant. I think it'll be relevant for the third place finisher. If it's Nikki Haley or DeSantis, I think the third place finisher will be out. We'll be down to 2 by next week in New Hampshire. But I don't think it's relevant in terms of who's going to win, because we all know who's going to win.
Does the margin of victory matter here? It's pretty noticeable that both Nikki Haley and Ron DeSantis are kind of steering clear of any criticisms of President Trump. To what extent might that yield results down the road?
Yeah, it could, Kriti, and I do think that this will be important in light of all the Republicans who are now rushing to endorse Donald Trump. We saw over the weekend Marco Rubio, who's never been a big fan of Trump, he endorsed Trump. A lot of other Republicans in the Senate are endorsing Trump now. So there's a sense of momentum. And even if Trump doesn't win 50% in New Hampshire, and I don't think he will, I think Haley will dig into his total. Once we get New Hampshire out of the way, then South Carolina, then Nevada, the really big story in politics and for the markets politically is Super Tuesday on March 5th. And it sure looks to me as if Trump is going to have a landslide on Super Tuesday, and it's entirely possible by the next day Trump will be the presumptive nominee.
But what is the kind of hot button issue here? I mean, there's so many, from trade to fiscal austerity, which it feels like the GOP is trying to really take ownership of, amid a variety of other international issues, not to mention the foreign policy concerns around Israel and Gaza at the moment. Greg, if there's one issue that kind of sets the candidates out, what would it be?
It's got to be immigration. And I've been saying for a while, and I would reiterate right now, that if Joe Biden loses this election, it will largely be because of immigration. I think the economy is coming back. It's not going to be a big plus for Biden, but it's not going to be as much of a drag as it appeared like 2 months ago. But immigration is huge. We had right before Christmas 10,000 people a day coming across the border. We had nearly 2 million people coming across the border illegally into the U.S. During the year of 2023. I think this has hurt Biden badly because there's a perception in both parties that he doesn't have a plan.
In terms of a plan, though, do President Trump, do Nikki Haley, do Ron DeSantis, do any of them have an immigration plan that's actually sustainable? I mean, didn't we see this in President Trump's own first presidency?
Yeah, we do have, though, a new dynamic, and that's the Speaker of the House, the new Speaker, Mike Johnson, who has been very outspoken about the Republican plan, H.R. 2. It's a plan that I think could never make it through the more liberal Senate, but it is a plan that has several goals, including finishing building of the wall. I think if there's a deal, we will finish with the wall. That will be a bitter pill to swallow for Biden and the Democrats.
Can we expand a little bit on Mike Johnson at the moment? He's kind of towing a very tough line in terms of even the stopgap funding bill that we've seen get passed just in the last 24 hours or so. But do you think he has what it takes to really kind of survive the pressures of his party when it comes to getting a lot more progress on the immigration front?
The jury is still out on Mike Johnson. He got off to a pretty good start. He was a breath of fresh air. People in the Republican Party didn't like Kevin McCarthy. But now Johnson faces a real crisis at the end of this week. On January 19th, part of the government could shut down. More of it could shut down on February 2nd. I think they'll do what we call a continuing resolution, and they'll extend all of this. They'll kick the can down the road until early March. But that's not definite. Johnson needs to get enough Republicans to go along with this, and the only way he gets that is to have Democrats join him. That's going to make Johnson a much less popular among House conservatives.
I mean, he's clearly trying to almost save face in so many regards when it comes to keeping the United States finances right back on track. Greg, one of my favorite kind of fun facts about the timeline for the United States the next 12 months is that right after the 2024 presidential election, January 2025 is when those fiscal deficit and this debt ceiling conversation comes back in. It's the very first thing on whoever the new president will be, whether it's President Biden or one of the GOP candidates as well. In your view, do you have any insight into what those debt conversations might look like at the start of not this year, but next year?
Well, they'll look dysfunctional, as usual. That Washington has made a fool of ourselves on the budget, and I think that will continue. I think that one of the real risks a year from now, as you mentioned, one of the real risks will be the credit rating agencies, Fitch, S&P. These agencies may further downgrade U.S. debt, not only because our debt is so enormous, but because we can't get a handle on doing anything.
So let's talk about these economic policies then as well. Nikki Haley has really established herself as having a plan to bring those debt concerns back under control, is something that Charles Koch, for example, has really lauded her for. Greg, do President Trump, do Ron DeSantis have a plan on that front?
Their plan is to reduce the deficit. But when you get into specifics, they're very hazy. Nobody wants to talk about Social Security or Medicare. is nobody has any specific plans, and when you get specific plans, the public tends to reject them.
Talk to us then about the plans they have been very vocal about, tax cuts, really returning to this idea of the GOP kind of being behind that, and even extending the 2017 Trump cuts as well. Is this the right time for that, given that even the Federal Reserve is trying to stay away from any realm of stimulus?
Yeah, it's a very, very good point. And I think as we get into the general election by this summer, this fall, tax cuts will be a big issue. It's very popular among Republicans, but I think most people in the markets are leery that we, as you say, we don't need more stimulus, and we sure don't need higher deficits. So I think tax cuts will be a dominant issue 7 or 8 months from now.
But it's interesting where these tax cuts are coming from. If you look at some of the policies that some of these GOP candidates have put forward, a lot of it comes at the expense of a lot of the Democratic funding, things around climate change, around EVs, among, of course, other social welfare programs. Greg, what might the budget look like in 12 months?
Well, obviously, we're going to show high deficits. I'm not sure we'll be at $2 trillion as we were in the last year, close to $2 trillion. But I would say that when you look at the budget issues, there's perhaps a growing sense that we spent too much money on infrastructure, too much money during COVID. I think all Republicans and some Democrats feel we have to curtail spending. So maybe we peaked out on spending. It's still going to go up for demographic reasons, but I think the deficit in this year may not be quite as bad as it was in the previous year.
All right, Greg, I got to wrap it up with you and talk a little bit about the foreign policy here. We've talked a lot about the economics of it, but I'm curious about where some of these GOP candidates might make or break it when it comes to Israel, when it comes to Ukraine, when it comes to China, at a time when President Biden right now is getting a lot of pushback on his own foreign policy record. What do you think of it?
It's a huge issue, obviously, and my fear is that Vladimir Putin will get what he wanted all along, and that would be a lack of resolve, a growing sense of indifference on the part of the West, especially the U.S., to aid Ukraine. And I think that aid to Ukraine is in trouble. It's going to be several weeks before we get it out of Congress, and you can just sense in Congress a growing lack of resolve to do more to help the Ukrainians.
It's certainly a lot to digest, and I think $100 billion is what's kind of put aside in Congress right now, $60 billion, which is tied to immigration spending on the southern border in order to clear that aid to Ukraine and Israel as well. Greg Vallier of AGF Investments, we thank you so much, and we appreciate your analysis this morning. It's a really hot-button issue, and of course, Bloomberg TV is going to have live coverage of what's going on in the Iowa caucuses and the platforms, the margin of victory that even the pollsters are saying that President Trump is going to have. But does that set the precedent then for the New Hampshire caucuses that we are going to get next week, where you do have a more independent base, and of course one where Nikki Haley is expected to come out on top of? A lot to think about. But coming up on the program, Nikolai Tangent, Norwegian Wealth Fund CEO, joining us from Davos. Stick with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Cryptocurrencies had its critics and still has many critics. Blockchain, nobody seems to be against that as a concept, depending whether you use it properly or not. So you are still fairly bullish on blockchain technology?
Yeah, I've been a bit of a skeptic on cryptocurrencies themselves since inception, and in some ways proven wrong regularly as they have gained in interest and activity. But I've always been of the belief that distributed ledger technology or blockchain technology has applications in the financial services world that as yet are still underexploited.
Do you have a view on whether digital currency authorized by a government is a good thing or not? And do you think the United States is going to be at the leadership of that or following other countries?
depends. So the benefits of a digital currency backed by a government are potentially greater ease of execution of transactions and greater visibility. If you use the central bank digital currency to intrude upon the privacy of the individual citizen, or to eliminate the role of the retail or high street bank from the financial system, then there are potentially very significant implications. That could be a consequence of a central bank digital currency.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In London, 9 a.m. in New York. I'm Guy Johnson in London. Welcome to Bloomberg Markets. U.S. markets closed today. It is, of course, Martin Luther King Jr. holiday, and as a result of which both the bond markets and the equity market are closed. We've got some futures for you. We'll show you that in just a moment. Equity markets are drifting. We obviously have got a lot to price in today, but with the US volume out, I don't think you're getting a clear signal. So what actually you're getting today out of Europe is a lot of analyst calls having quite a big impact. So there's a downgrade on HSBC. L'Oreal is under a little bit of pressure. Some of the delivery companies, home food delivery companies, are under a little bit of pressure as well. As a result of which, you are seeing some weakness, but I think it's sector, single stock specific. I think there's a macro kind of story today. Other than, I have to say, over the last 24 hours, I've been surprised by the number of ECB speakers that have come out and told us that we're going to have to wait for rate cuts, and even one, I think, Philip Holtzman, talking about the fact that we may not see any rate cuts at all in 2024, which is in stark contrast, of course, to how we started the year. We started the year by thinking that we were going to have a soft landing. We started the year by thinking that that soft landing would be accompanied by multiple rate cuts, and that everything was going to be good, and this was going to be a beautiful and an immaculate disinflation process that we were going to go through. 15 days in, does that still apply? So here's our question for the day. Is the outlook for 2024 becoming clearer, or dare I say it, maybe a little murkier? Joining us to discuss, Michael Masika and Marcus Ashworth, the Bloomberg Opinion. Michael, you're standing next to me. What do you think? Have you got a clearer view of the world today versus the beginning of the year? I appreciate that it's only the 15th.
Yeah, it's only the 15th, Guy, but I totally get the question. We're having an outlook that is blurrier now than it used to be. I mean, we came into the year with like rate cuts are coming, earnings are still doing fine, soft landing is coming. Now it's like we don't know anymore. Like you said, the central banks are giving mixed messages, so we're not really sure anymore. But they kind of have the habit of doing that quite often to calm down exuberance. So I think that's the thing that have changed this year. Like we have a huge improvement in positioning and investors rushing into equities. You have earnings that are very steady, but with expectations, like great expectations for this year and the next. And at the same time, you have a lot of rate cuts priced in, still priced in after Holtzman today, still in there. So it's like, something's got to give somewhere. So it's completely like all over the place.
Of course, no, not at all. Stick with the plan. I said in October on your show in November, buy the market, buy the bonds, buy equities, and I stick with that view. Lovely little sell-off in bonds here to be lent into. Clearly, you can see the huge supply and therefore demand matching it in Europe's corporate and government bonds, new issues. So that gives me great confidence that this year will be the year of rate cuts. I echo what Michael's just said regarding what the ECB in particular trying their best to persuade us on. Nigel and Bundesbank saying, don't, we may think about it after summer. Holtzman said before he doesn't expect to see rates cuts this year. I think they're both wishful thinking, and I think we'll see a rate cut probably in late spring across, started by the Fed, then the ECB, and then finally, along last, the Bank of England. And
Marcus, I think,
what if that doesn't happen? What if that doesn't happen? The data out of the United States, and I'm going to park the European data for now, but let's look at the data out of the United States. The labour market is not rolling over. It remains strong. CPI remains relatively elevated and is coming down more slowly. You talk to people in the industrial sector, they talk about a re-acceleration. Why is the data not telling us that we should push these rate cuts out? Well, I mean, firstly, don't look at the data, especially backward-looking, lagging data. Labour and inflation data are proved to be utter rubbish for the last 2 years, and I would not put too much on that. Look at the survey data maybe, look at expectations from both purchasing managers and indeed other decision-making panels that central bankers have. And just look out the window, really. Inflation is coming down. It's coming down quite hard. Yes, there are some base effects which cause this, December month not to be quite as weak as the previous ones, which were very weak and have continued to be weak and will continue to be weak. So as far as the economy is concerned, just look at the 0.3 drop in German GDP. That's why central banks need to get their act together, otherwise they're going to get a recession, which I don't think they need to have. And that's the point. We're not talking about crazy interest rate cuts. We're not talking about them happening in the first quarter. I'm talking about a steady plan in the second quarter that is long-term for this year, positive for both stocks and bonds, unless something else happens. But look at oil price, it won't go up.
Michael, what happens if we don't get rate cuts? What happens if we get rate cuts later? Just talk to me about how the models are performing at the moment, how stretched some of this positioning is. If you plug in a higher rate from central banks, what happens to those models? What kind of trading stories are they kicking out?
Well, you get those systematic strategies, volatility funds that have been buying equity futures in Europe and in the US with like quite high positioning at the minute, and those have been acting according to what the bond market is pricing, kind of, and they're very, very fast to adjust. So when you have like a misprice from the bond market on rate cuts and there's an adjustment, those funds will adjust as well. So you can expect some heightened volatility, not necessarily a crash, but I mean, you can see we're getting close to like stretch level in terms of technicals, in terms of positioning, and those can reverse quickly. So you will have like a decent drop, but probably not a crash. And like Marcus was saying, the outlook is still not bad. So there's no reason to be like a seller and like being completely off the market. But can you have a little drop? Yeah, definitely. Outlook isn't bad,
no,
but
it's not.
6 rate cuts is maybe a stretch then if the outlook isn't that bad. Guys, we're going to leave it there. Thank you very much. Michael Masika, Marcus Ashworth, talking us through the start of 2024 and whether or not we got some more clarity. Talking of clarity, if you want clarity, there's one place to go this week. The World Economic Forum is taking place in Davos. Francine Lacqua is there with the Norwegian Wealth Fund CEO. Fran, over to you.
Yeah, I don't know whether you get clarity in general, but certainly you get clarity when you speak to Nicolai Tangen, the Norges Bank Chief Executive Officer. At least you hope that actually you get the Norwegian Sovereign Wealth Fund to make sense of everything that's going wrong and puts us a lot of angst in the world. So, Nicolai, thank you so much for joining us. There's trade, there's geopolitics, there's just not great news out there. How does it impact your investment outlook?
No, I agree. It doesn't look very good, actually, and we are not very optimistic when it comes to returns this year and the next few years, actually. And if we start with rates internationally, I do not see them coming down as fast as many other people. I think we have some underlying inflationary pressures. We've got wages now, wage demand really high in a lot of countries, and so that could lead to some, spiraling of inflation going forward. So. Then you have some climate effects, which are negative on pricing. You have geopolitics, you have trade routes, just a lot of things. It's just not a very happy cocktail.
But so if you look at the trade routes and the concern, of course, in some of the straits, which means that they have to go around, could that actually impact negatively the world economy if this lasts for much longer or gets worse?
Absolutely, because we are seeing freight rates going up, and we are seeing problems also with the Panama Canal. So some of these trade routes are, being held back a bit.
But so, and I know you're a long-term investor, but how do you look at the next 12, 24 months? It's hard if you're losing money to stay the course when you see the world around you changing.
Yes, but we are, a very large fund, and you have to be extremely long-term in your thinking, and you have to be really well diversified, which is what we are. We own basically a small part of the whole world, and so we just have to be there for the long term.
But do you not see the world changing? So we were talking about the cost of credit, the cost of money, the fact that this is changing also for structural reasons, that it's not only because of the wave of interest rates that we've seen.
Yes, so money is not free anymore, and I don't think it will be for a long period of time. And so, of course, that has implications for companies which have got debt. We are seeing it in the real estate market negatively, and so we are seeing it a lot of places. But probably we've seen the big jump in cost of capital. So from here, it's probably going to normalize a bit going forward.
So I know you have a great podcast, which also means that you understand the companies you're invested in maybe a little bit better than others. Like, what's always your killer question to understand whether you want to keep invested in some of those industries?
Well, what I think is really, so we have this podcast called In Good Company, and we interview the top leaders in the world. Yeah. What I think is interesting is just how big a difference management can make. You have two businesses which seem to be similar and exactly the same thing, and one is doing extremely well and one is just doing badly. And it's coming from the top. It's about corporate culture. It's how they instill the passion and the drive in the business. It's really, really fascinating.
But it's also frustrating. If you're a long-term investor and you say, actually, this is what my bet is, it's on AI, it's on this changing the way we do the economy, then how do you choose the companies?
Well, we have, thankfully, a lot of really, really good portfolio managers in Norges Bank Investment Management. And so the picking of the companies, that's decentralized to the portfolio managers themselves.
Is there anything, 2023 was probably the year that we saw the world economy really being resilient. Does that change how you see the world economy going forward?
What really derails things is the things we never thought about, right? The financial crisis, an earthquake, the COVID, those type of situations, that's what's going to derail it. And we don't know what the joker for 24 is going to be, but for sure it's going to be something that none of us have thought about.
Yeah. What happens to the oil price, though?
I don't know. I'm not a specialist in energy, in the energy market.
But so when no one is an expert, frankly, in the energy market, because you now have to be like a geopolitical, whisperer to the greats and the goods to try and understand what goes on next. Do you come to Davos to try and figure out what these hot spots mean for investors? Like, what are money markets getting wrong right now?
Well, we are meeting a lot of CEOs, which is really, really interesting. Yeah. I love to talk to the companies about how they are seeing the inflationary pressures, because sometimes the central banks are a bit backward-looking in the data, and so to talk to them and see what they are actually seeing now and what they expect to see over the next few months, that's really, really interesting, and that really forms overview.
When you have a bad quarter, what do you tell your stakeholders? That it's in the longer-term game? Again, how difficult is it to try and manage all the volatility?
Well, so we are so large. So we are running the fund close to the index, and we have a fantastic mandate, which is made by the Ministry of Finance, and we have great people in the ministry, and so and there is a deep understanding of how we work. And so when we have a bad quarter, it's typically not a surprise. right? Because the market has been behaving badly, and so therefore it follows that we also will have a bad quarter.
But if you think that the interest rate cuts are not coming, is it because the U.S. economy is more fragile than we think?
No, I just think there is more underlying inflationary pressure, you know, and I think it's going to stay there for longer. And I do think the international central banks will be very, very careful in cutting rates too quickly because they were too slow in putting them up.
What does that mean for your returns?
Oh, I think they will be lackluster, you know. I think we'll have low returns for the next few years.
But there's not, you can't change the portfolio to try and make up for that, or no. It's kind of like steady as you go?
No, you can't really. I mean, when you are the size we are, it's very, very tough to change. And also, you know, when you have like a time horizon of 20, 30 years, all you want to do is to be invested and compound and basically benefit from the earnings growth in the companies. And so that's what we're doing.
Is there a story you think that will come out of the world economy that we haven't really talked about yet? I know a lot has been done about AI. Is there anything else coming in terms of innovation that could make you change the way we look at the world?
Well, AI is going to be a big driver for efficiency. And, you know, I had this kind of starting assumption that we will increase productivity in the fund by 10%. Now, then I have Sam Altman on our podcast, and I asked him, "Hi, Sam, what do you think?" And he said, "Nicola, you're way too conservative. You should be increasing your productivity by 20%. So what do? I walk around in the office and say, "Hey, guys, you know, 20% improved efficiency. Where is it coming from?"
And where is it going to come from?
It is going to go all over the place. All over the place. It's really transformational for so many things.
But so what does that mean from an investment point of view, that you actually buy the companies that are at the forefront of AI?
So that's a very, very difficult question, because how much is now in the prices? You know, you have the dot-com boom with huge rally in the internet shares. Did it happen? Yes, it did. 10 years later, right? And in the meantime, share prices went down. So I wouldn't be surprised if we saw a correction in the AI-related companies. That could easily happen. Doesn't mean that AI is not real.
But what does it mean for stock investors, for stock pickers? It feels like the world is a little bit upside down, even the correlation between treasuries and stocks.
I mean, the way to make money in the stock market is to do the opposite of everybody else, okay? So you buy what is completely out of favor and you sell what is really hot. That is just like the way to make money in the long term. You have to be contrarian, and there is mean reversion in the stock market, so that's the way to do it.
So what's your most contrarian view right now?
Well, you know, some of the green transition companies have done badly over the last year or so, and of course ESG has become, you know, a bad word in parts of the world, and so I suspect there are some interesting opportunities there now.
Does it change also? I mean, I know we're looking at U.S. elections. We're looking at over 50% of world GDP citizens going to the polls this year. How unnerving is that? From, again, just to try and understand where the economy does next.
Well, it's a very good question, right? So we'll have some big changes potentially in many places. What the implications are for financial markets is less clear. Because you often have two people who have very, very different views, but they may both be pretty positive for business. So it's difficult to say what the implications are going to be.
I can't get out of my mind like 20% more productivity. You know, my boss is going to say the same as soon as I get off here. Does that mean, how do you change then the number of employees you have? Does it change?
I think we're going to do more with the same number of people. I think we're going to do more.
More in terms of what analysis or countries you cover?
More analysis, better data, you know, hopefully better investments, just the whole thing.
Okay, what are you most looking forward to in Davos?
I have a whole, I got back-to-back meetings over the next 3 days. I'm really looking forward to meeting so many people. There are so many deep thinkers, and just to get a lot of inspiration and impulses. Very important to be here.
I mean, do you have a question you need answered? That you know, is it inflation? Is it the cost of money, or is it something else that you wish you had a crystal ball for?
You know, what I always do is just to start with an open-ended question. You know, what's on your mind? What's on your mind? So, you know, I asked your boss just before this interview, what's on his mind?
And he said productivity. There you
AI.
go. I knew you would, Nikolai. Thank you so much for joining us. Nikolai Tangen there, the Norges Bank Investment Management Chief Executive Officer. Guy, I'm going to hand it back to you in London. We'll work on our productivity here, and then we'll come back to you throughout the day.
20%. I want the next series of interviews, Fran, to be 20% better. Everything's got to be 20% better. It's going to get throughout the show. It's going to compound as well. Nikolai Tangen, Francine Lacroix, fantastic conversation. Thank you very much indeed. Fran's got some great interviews coming up. Honestly, you do not want to tear your eyes away from what's happening in Davos. Just to recap some of the things that were said there by Nikolai, not very optimistic about returns over the next few years. Certainly sees a risk of spiraling inflation. Wouldn't be surprised if there was a correction in AI stocks. Okay, coming up, more insights, 20% more insight into our question of the day. Is the outlook for 2024 becoming clearer? Christopher Zook, CAS Investments CIO, joining us next. This is Bloomberg.
All this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
Inflation has become stickier than we think, or than the market thinks right now, for various reasons. We have lower growth, we have very high government spending, we have a fractured, geopolitical system. So all this basically raises cost, and what we're going to find as inflation drops now, mostly driven by goods prices, by the end of the year we're going to realize that it doesn't settle easily at 2%, let alone at something less so that you cut rates. But I think, more likely we're going to settle probably slightly above 2%, which means central banks are going to have to stay on alert.
That was, of course, Philip Hildebrand, now BlackRock, formerly of the S&P, talking to Francine a little bit earlier on from the World Economic Forum. Just a couple of things to throw in on top of what Philip was saying. You just had the Norwegian Sovereign Wealth Fund, Nikolai Tangen, talking about the risk of spiraling inflation. He is not convinced, we just heard that a few moments ago, that inflation is going to be easily tamed. And you just had as well a US advisory, we understand, going out regarding the Red Sea route, indicating that route is still too risky for ships. Again, an inflationary narrative which may not have been there at the beginning of this year that we hadn't factored in. So is the outlook for 2024 becoming clearer, or dare I say it, a little bit murkier? Christopher Zook, CAS Investments CIO, joining us now. Christopher, what do you think? What did you think at the beginning of this year, and has that view started maybe to change a little bit as we work our way through January?
Good morning, and thank you for having me. The most interesting thing about our view is that it really has not changed that much. So we came into this year thinking that inflation was going to be stickier, thinking that the Federal Reserve is going to continue to be in a box. And we continue to believe that today because the data that we got last week just confirms that right now the Federal Reserve has got to be very, very careful about cutting rates too soon and having a repeat of what happened in the early 80s. That is what investors should be afraid of, is a repeat of that playbook.
The central banks around the world are certainly of a view that they don't want to play the Burns playbook basically, and have to have Volcker come in and sort it out. So what do you do with that? How do you turn that into an investment thesis? Stocks have been on a charge, continue to be on a charge. There's still this buy the dip mentality. Bonds had a great run at the back end of last year. We've seen a little bit of that fading. Build me a portfolio around that Fed in a box thesis.
So the Fed in the box thesis lends someone to say just traditional stocks and bonds is not necessarily a great place to be. And so we are very much in the camp that people need to be diversified across lots of different asset classes. Public markets, of course, have a piece of that, but also the private markets as well. And, in February, I have a book coming out that I wrote with Tony Robbins called The Holy Grail of Investing, which is a nod to Ray Dalio and talking about how you have to have these uncorrelated asset classes. That's the way investors need to be thinking right now. Yep. Today, the S&P 500 has one of the worst outlooks over the next decade that it's had in literally the last 40 years. If you look at any number of metrics on valuation, it's just not a great place to just being, buying vanilla stocks, if you will.
Absolutely. Christopher, there was a note out from Torsten Slot from Apollo a little earlier on today talking about these stretched valuations U.S. stocks have with the rest of the world. Should I refine that a little bit and just talk about U.S. tech stocks versus the rest of the world? What happens if tech wobbles in the United States?
Well, what most people forget when they're focusing on the Magnificent Seven, they're wonderful companies. They have great market positions, but they're very, very expensive. And from peak to trough, in 2021 to 2022, those stocks declined by 50%, 50. So if that is 30% of the S&P 500 and 50% of the NASDAQ, I'm not saying they're going to go down 50%. But if they go down materially, then everything else in the index world is going to come down. So the other 493 stocks, there are some good values there. But the reality is you have to separate and look at, not just at the Magnificent Seven and not just look at the indices, because there's a lot more value around the world that can be had if somebody is willing to go look as opposed to just clicking a button and buying the index.
Christopher, you mentioned Ray Dalio just a few moments ago. I can't remember when it was. I think it was probably pre-pandemic. Ray was at Davos, the World Economic Forum, and he came out with a famous line. Cash is trash. Is cash going to be trash in 2024?
Cash may actually be a pretty good asset this year because you're getting paid very well to sit in it. Now, on an inflation-adjusted basis, it's still not great, but at least it's a positive return today. When Ray made that statement a couple of years ago, it was a negative real rate of return. Today, it is a positive real rate of return. If you're getting 5 1/4 and it's a negative real rate of return, that means inflation's more than 5 1/4. And if that happens, the Federal Reserve is going to hike rates dramatically. So I think cash is not a bad place to be as part of the overall plan of the portfolio, but I wouldn't make it 100% of the portfolio either.
Do you think we get more? Over the last, certainly the back end of last year, bonds and equities traded in tandem. I keep laughing, keep getting fund managers on saying, yeah, look at the 60-40. Had a great back end of last year, went up by, I can't remember what it was, 10+%. I'm like, but it's not meant to do that. You're meant to have these things as being uncorrelated assets. Are we going to say what are the uncorrelated assets? What are the hedges, one way or the other, that I can do here? When I get this, I get that. When I get that, I get this. How do I build a portfolio that has some of that diversification in it? You outlined some of the areas, but how correlated are some of those areas that you've outlined?
They're very highly correlated right now in the traditional world, and that's very disconcerting for investors because in order to put together a holy grail of investing portfolio, you must find things that are not as correlated. So bonds next year, the rest of 2024 and next year in 25, could actually provide some correlation benefits or low correlation benefits, because if we have a major recession that causes the Federal Reserve to cut interest rates, most likely stocks are going to get hammered, but bonds are going to do very well. So in that environment, it actually could do some good. Yep. It could give you some correlation benefits, but you really got to go outside of that. You need to look at international. You need to look at emerging markets.
Christopher?
You need as well.
I'm going to leave you to the rest of your holiday. We've got to go. Great to see you. Thank you, sir.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Coming up to 5:30. Welcome back. You're watching Bloomberg Markets. I've got to take you back to the World Economic Forum. It's going to be a big theme this week. You've got some really smart people there talking about how they see the world. Former US Vice President Al Gore speaking earlier to Francine about the progress that he has seen being made on the environment and what came out of last year's COP28 and what it tells us about the challenges for 2024. Take a listen.
The time has come to reform this process. The world is getting understandably impatient and frustrated that these conferences are rigged. They're rigged. The deck is stacked in favor of the fossil fuel industry.
But we did have agreements. So again, how do you match
such
the
as
two?
they
Would
are.
you have,
such as they are. There's so many loopholes and so many tricky phrases. And it took 28 COPs, 28 years of COPs before we even could use the phrase fossil fuels. The climate crisis is a fossil fuel crisis. That's what it is. And yet it's taken us this long to overcome their resistance and even naming the problem.
what happens to climate change pledges from the U.S. if President Trump has a second term?
Well, first of all, let me say that I think that in spite of the loopholes I mentioned in this agreement, and in spite of the frustration many of the climate advocates, such as I, have felt about it, nevertheless, we see the direction of travel, as they use that phrase, for both business and government, shifting inexorably toward low-carbon, renewable energy, and toward net zero. We see the same thing here at the World Economic Forum. This place is sometimes criticized. It's unique in bringing all kinds of people together in a way that doesn't happen anywhere else. And your question was,
if President Trump gets into the White House, what does that mean?
First of all, I of course hope that doesn't happen. There are many of my fellow Americans who are for him. You know, look at the last time when he became president, we continued the march toward renewable energy.
On the business side.
On the business side, and state governments continued to pursue carbon reduction. Here in Davos, a Republican red state governor from Georgia is leading off talking about the virtues of electric vehicles. We are seeing with the legislation that President Biden got passed the Inflation Reduction Act, as it's called, the biggest climate legislation any nation's ever passed in history. We're seeing a change in the political realities on the ground in the U.S. with the creation of tens of thousands of new jobs in electric vehicles, batteries, wind, solar, efficiency, green hydrogen, and now some of these red states in particular, they're now seeing the benefits of all these new jobs being created. It's really changing the reality.
Do you think Donald Trump won't try and touch that?
I wouldn't even begin to predict what goes on in his calculations. And of course, tonight we will see the results of the first contest, which all the pundits tell us he's likely to win. But in New Hampshire, it could be a different story.
Former VP Al Gore, speaking of Francine in Davos a little bit earlier on, laying out some of the challenges that are going to be with us during 2024. Let's get back to our question of the day on that front. 2024, it's what, the 15th of January? So much has changed since the start of the year. So what does that mean in terms of figuring out how to invest for the rest of the year? Tim Pagliara, Chief Investment Officer at Camp Wealth, joins us now to discuss. A, thank you very much indeed for joining us this holiday. B, let's talk about 2024. We came into this year talking about the idea that we were going to see a soft landing. There were going to be lots of rate cuts, and that it was a great environment, therefore, for buying bonds, for buying stocks. Is that starting to fray around the edges?
I think they were still going to have a soft landing absent the rate cuts. I think everybody's was a little too aggressive, and it was actually aided by Powell's comments that, you know, we could see as many as 6. Now it's questionable based upon, you know, what they're saying in Davos. They've kind of ripped the Band-Aid off of this. We might not even get 3.
Okay, so let's talk about, if you get 3, what would that mean in terms of where assets are? We've seen a really strong run back end of last year. Bonds got bid. Equity markets, they've wobbled a little at the beginning of this year, but still we're up near record highs. Can we stay there? Can we advance from here if we only get 3?
I think we can. I think that the main reason, if they cut rates, will be to help de-invert the yield curve. And when the yield curve's de-inverted, the Treasury's borrowing costs will go down because they have a tendency to borrow at the short end of the market, which is still very high. So that's the only reason that I can see that they will change or cut rates. The 10-year Treasury, it's appropriately priced right now if we were at 2% inflation, and we're not. So I don't expect any relief there. In fact, I could foresee the 10-year and the 30-year going up from here as the market digests the reality of inflation.
To where? To where? Do you think we get back to anything approaching 5%?
I think you could approach 4.5%, 4.75% if inflation continues to come in hot on the 10-year. Yes. And I could see a corresponding cut in the short-term rates.
A couple of things around this. Let's just talk about inflation for a moment. Do you think, there's a lot of people in Davos, and you talked about ripping the Band-Aid off. There's a lot of people in Davos that are clearly very concerned still about inflation. Is there still cause for concern on inflation?
Yes, the Federal Reserve is ignoring a number of things. For example, wage inflation settled in at about 5.3%. Chairman Powell, says that any wage growth, any wage increase above 3.25% that's not accompanied by productivity is inflationary. So if your target is 2% inflation and you've got 5.3% wage inflation, and you have every day we're reading about strikes and labor unrest. This morning there was a piece about the nurses in Chicago getting ready to go on strike. That's not the kind of environment that's conducive to lower inflation.
Okay, so let's say inflation is stickier than we anticipated. The Fed cuts 2-3 times this year. Talk to me about the kind of returns that we should be looking at. We just had the head of the Norwegian Sovereign Wealth Fund on, one of the biggest sovereign wealth funds in the world, talking about low returns. Is that what we should expect now, low returns?
In the indexes, yes, because they're so dominated by the Magnificent Seven that you almost have to have some reversion to the mean. Let's remember, the 25-year return in NASDAQ is less than 6%. So all we're doing is going back and revisiting historical returns. So a lot of people think that, got to the mistaken belief that you could grow at 15, 16% a year on equities. That's just unrealistic. Always been unrealistic.
We talk about the Magnificent Seven as growth stocks. How cyclical do you think they are? Let's look at this from the other end of the telescope. If you were to get a downturn, do you think there would be more cyclicality in those stocks than you would originally have thought?
Possibly, but I think that the focus will just be on valuation. They will drop from 50 times earnings if the economy slows. It's just inevitable. So if you have a 10% drop in the price of NVIDIA, that's over $100 billion that has to be made up by something else in the S&P 500 or NASDAQ. So you drop Tesla, you drop NVIDIA, 10, 15%, and the indexes are going to look really poor, in terms of return. So that it's going to be a stock picker's market, just like it was in the 70s.
Okay. How easy is that going to... This year feels like it's going to be volatile, Tim. And I'm wondering, in a stock picker's world, how easy it is going to be to pick stocks. You look at last year, the S&P had a great year in picking stocks. And this is always the challenge that a lot of people face. They listen to people like you talking about the idea that we're in a stock picker's market, but then they get into some of those stocks and they get whipped around. And I'm wondering kind of how people should therefore manage that process. What's your advice on managing that process? Picking good stocks is obviously the starting point, but the volatility, even with good stocks, is likely to be relatively high.
It's going to require incredible discipline. So we're holding over 20% short-term U.S. Treasuries, and we're waiting. Henry Druckenmiller was on back in the fall, and he said, the best thing I have going for me right now is I don't have clients and I don't have to deal with FOMO. My good friend Larry McDonald talks about the head fake with rates. Jeff Gundlach talked about it. He predicted this short-term decline in rates en route to rates going up longer term because of the lack of fiscal discipline. So I think you have to be incredibly disciplined and wait because I think one of your prior interviews, he said, Treasuries, cash is not trash. Treasuries in the 5% range present a reasonable asset class, a good return in what will be, in your own words, a very, very volatile environment, I think, in 2024.
Been great to catch up. Thanks for stopping by on a holiday. We really appreciate it, Tim. Tim Pagliara, Chief Investment Officer at Cap Wealth. Sir, thank you very much indeed. Okay, coming up, thousands of angry farmers protesting in Berlin today. This while the latest GDP numbers show Germany narrowing, escaping, falling into a recession. This is a unpopular, you could say, and I do that with a degree of understatement, coalition in Germany right now. We'll turn our attention to what is happening there next. This is Bloomberg.
are some of the measures the government are working on in terms of addressing the artisanal challenges there?
Oh, a host of them, I mean, but fundamentally hinged on two policy pillars. One is reformation, which is reforming the sector, licensing regime, getting them equipment for the extraction of the gold from the ore without the use of mercury. As you know, we are parties to the Minamata Convention, and therefore we respect the dictates of the Minamata Convention. And then the enforcement regime, deploying law enforcement to make sure that people are arrested and so on and so on. So we're making that effort. But my point is that, my fundamental point is exploiting these mineral resources in a sustainable manner are not mutually exclusive. Yep. I think that they can peaceably coexist. You can exploit the resources, and several countries have done so. I don't want to mention, give examples, but I know of countries which have gone about their mining sector and their mining industry in a manner which is also protected the integrity of the environment and the climate. We can do all of that. My friend Josephine mentioned the day we'll use solar to mine and use gas and all of that. These are all very ambitious technological interventions we can rely on. And Ghana is doing just that.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So weak German GDP out a little bit earlier on today. This happening on the same day that thousands of angry farmers descended on Berlin with their tractors and loudly booed a government minister, rounding off a week of nationwide protests against plans to cut tax for agricultural fuel. More than 5,000 tractors were blocking the streets, honking their horns, leaving their engines on. It was pretty busy. Oliver Crook was out there covering it for us and joins us now from Berlin. Ollie, let's talk about what's happening here, because Germany feels like a very unhappy place. And it's unhappy about a lot of things. How does the farmer protest fit into that?
So I think that you can really tie these two together, the GDP story and this sort of the farmer protest story in a sort of very clean way, because this is really where the rubber hits the road on two stories we've spent a lot of time talking about, but this is the real manifestation of it. First, the budget crisis. Ostensibly, this was prompted by the fact that the government had to roll back these tax subsidies on the farmers because of this budget crisis and those funds that disappeared suddenly overnight, and they had to plug the hole. And the reality of plugging that hole is taking money from somebody in Germany, right? And in this case, the farmers. So that has culminated in literally thousands and thousands of tractors in the streets here, honking their horns, completely paralyzing the city. And then the second thing we saw today of the rubber hitting the road is contraction in Germany. 2023, though they dodged a recession, so what? It was a contraction year. And the question is, what does this look like going forward into 2024? The pool of economists that we've spoken to say that there's going to be slight growth in Germany. But if you ask Commerzbank and you ask Deutsche Bank, they both expect contraction. And so the direction of travel is what people are focused on.
Is this the same, though, as the protests we see on the railways at Deutsche Bahn? Is this the same view being expressed as we see in the votes for the AfD? Are there different strands here that we need to focus on, or can you just see it all as being the same melting pot?
Listen, I think there are different strands in the sense that, you know, the Deutsche Bahn protest is about getting those wages up, but it's basically, I think that you can say, broadly speaking, Guy, and this may be sort of a cudgel, but it's a very prosperous nation that is shrinking and that is getting poorer, and that is not something that people feel very secure with, and that is something that is very scary to people, and that will manifest itself in many different ways. And the way that it's going to manifest itself politically, at least the AfD hopes, is a protest vote, a protest for the fringes of German German politics. And when we talk about that, the AfD, which is the Alternative for Deutschland, really a very, very far-right party, it is now the second party in Germany. It has 23% of the national vote. And this is all going to come off, into a really severe focus in September when you have 3 state elections, all in East Germany, that if they were held today would be completely swept by the AfD, which is really without precedent in kind of the contemporary times in Germany.
Ollie, great coverage this morning. Really enjoyed seeing what was happening there. Anything that involves a tractor, it's got to be a win. Ollie Crook, thank you very much indeed. I want to take you back to what is happening at the World Economic Forum in Davos. Joining us now for another exclusive interview is the Qatari Investment Authority CEO, joined by Francine Lacroix. Francine, back over to you.
Yeah, thank you so much, Guy. As ever, we're delighted to be joined by the QIA Chief Executive, as you were saying, Mansour bin Ibrahim Mansour. Thank you so much, sir, for joining us. There's so much going on in the world economy. I mean, there's so many questions about inflation, about the cost of capital, the cost of credit, where investments will go. Are you optimistic about the year ahead?
I think this year will bring a lot of clarities. I think we have been fighting the inflation, and we have been bringing the numbers down. And this year will confirm whether we are, we defeated the inflation or not. I think the market is also anticipating a cut, and there is a different views whether we'll have a big cut, like 6 times. I see this as unrealistic, but I'm sure if the numbers come down, I think we will see a little bit of the cut.
But so when are you expecting, when you look at your priorities for investment this year, what do they look like?
See, priorities are, we are active in all sectors, all the time, all the years. What matters are the themes that we have from year to year. For example, technologies. We are very interested in enterprise software, digitalization, AI. AI is becoming very important technologies. It's a game changer. And we really value businesses that really embedded AI in their business models. Healthcare is a big theme as well. A lot of AI could be used in healthcare. People are very conscious about their health, are spending on this space. Government are starting to admit that they have not invested in healthcare sector, so a lot of opportunities will come to the surface. On top of this, you have an aging population that I think, science and biology will make sure to bring a lot of technologies and invention.
And I understand, of course, you're a long-term investor. Everything is, further out and takes years. But we have seen some changes in some of your portfolios, including, for example, for Barclays. So does it mean that you would likely to add, for example, to some of the or healthcare companies?
You will see us from time to time exiting or reducing some of the exposure. And this is a normal, activities. I mean, repositioning the portfolio is I think it's a healthy thing in our DNA. We still hold a big stake in Barclays, around 3%, but we are continuing investing in UK and Europe. There is we are not signaling anything out of this.
Which is what I was going to ask you. You're also, of course, very invested in Canary Wharf.
Yes.
Are you concerned about commercial property?
I think commercial properties, yes, because of the leverage and cost of funding. It's becoming, especially if you have debt on some of the, also in the offices space, as I think it has a little bit of risk. But
you would keep it, or is it something that you'd be looking to sell?
No, we are keeping. Again, we are long-term investors. The good things that we have, stable financial capabilities, and we have a strong partner in Canary Wharf. We have agreed that we keep supporting the project, and it is not time to exit it by all means.
When you look at regions, are you more positive on the U.S. than other parts of the world because of the strength of the economy? There are also many uncertainties in terms of division inwards and the elections coming up.
See, the U.S. market is the biggest market for our investment. But nowadays, I see that other equity market might perform better. Japan looks very interesting. Europe looks better, by the way, in terms of the PEs. I think the market is anticipating a big cut. which is unrealistic from my perspective.
For Fed cuts, you're expecting no Fed cuts this year?
No, I'm expecting there is a cut. Especially, everything depends on the data that we will be seeing during the first quarter and second quarter. But I am anticipating a cut, but not as the magnitude that the market is anticipating.
How difficult is it to see what happens on geopolitics? I mean, Qatar was also one of the brokerage in some of what we're seeing in the Middle East. Does that change your view on how you're invested in the region?
First of all, I'm very proud of my government doing in terms of mediating the two parties, and I'm sorry about the casualties that has been hurt during this conflict, and I pray day and night to settle this as soon as possible. But yes, I think getting into 2024 with a lot of geopolitical conflict and with a lot of election, I feel that there is, the societal challenges will be one of the risks that we are monitoring very closely.
So does it mean that this year is more difficult to understand, more difficult to read than even early 2023 was?
No, I don't think so in the short term, but I think in the long term, I think this is something that we should be aware of, monitor how people will think about this issues and the polarization that we see in societies. These are one of the biggest risks that we see in the long term.
So are we underestimating polarization and the impact this has on the world economy and therefore our investments?
Definitely with the globalization. I mean, the world is becoming very small. Of course, this will have an impact on a trade and deglobalization in terms of the policy making and different government. In terms of the election that we see, this year is a big election everywhere, maybe 60 election. Definitely, will have some sort of impact to the world economy.
And so, presumably, does it also change, of course, how you see the trajectory of regions that you want to be invested in? I know you mentioned Europe, for example, as having potentially, opportunities. Is this because valuations were so cheap, or because you're expecting growth to be okay?
No, I think valuation is cheap now in Europe. But I hope this is not changing our long-term strategy. We have a long-term strategy that we have set, and we have a very proper asset allocation. And we are going to continue in the same norms. Nothing to change at this moment.
Anything with China? Again, this year was meant to be the year that China was reopening.
Yes.
That there was a lot of positivity coming from China, which we haven't seen yet.
Yes, China is going through challenges right now. There is no doubt. You are talking about local government would like to deleverage. You are talking about consumer and not spending. You have the real estate problem as well. But China is a big market. You cannot ignore it, and it should be part of your asset allocation, especially if you are a long-term investors.
Mansour Al-Mahmoud, thank you so much for joining us here today. That was, of course, the Chief Executive Officer of the Qatar Investment Authority. With that guy, I'm going to send it back to you in London. And then it's only day one, so we have 4 more days of Davos 2024.
It's going really well so far. Some really fantastic conversations already coming out of Davos. This view about inflation, I think, is fascinating. We're hearing it consistently now across the board. Plenty more guests coming from Francine and the rest of the team. Doesn't the snow look good? Out of the World Economic Forum. Okay, European markets open today. US markets closed today. As a result of which, as you would expect, volume is a little light. Stock 600 down by around 0.6%. What I think is interesting today is that actually we're seeing a little bit of a sell-off in the bond market, which is fascinating. Brent crude is softening a little bit as well, despite the fact we are seeing warnings remaining around the Red Sea. What are we going to do next? We'll carry on with our conversation of the day. How clear is 2024? We're going to ask that question to Steve Sosnick, Interactive Brokers Chief Strategist. He is going to be joining us next. This is Bloomberg.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
$10 a.m. in New York, 3 p.m. in London. I'm Guy Johnson. Welcome to Bloomberg Markets. In the US, we're closed. It is Martin Luther King Jr. today, holiday today, and as a result of which there is no trading. We do have futures trading. I'll show you that in just a moment. Over here in Europe, we've got things to think about. There's a lot going on at the World Economic Forum. We're going to fold that in to our day as it progresses. This is the story as we find it at the moment. Stocks are a little softer. S&P futures a little softer. Pound's a little softer. The dollar's actually having a reasonably okay day today, but I would take all of this price action with a substantial pinch of salt. We'll wait for the US to return. We've actually got quite a lot of data to work our way through this week, and still a lot of earnings to think about. Big banks still very much on deck this week. But let's get back to our question of the day. We are 15 days into 2024. We came into the beginning of this year with a huge amount of certainty, didn't we? We're going to get a soft landing. It's going to be great. We're going to get lots of rate cuts. It's going to be great. We're going to be able to buy risk assets. It's going to be great. Is the outlook for 2024 still looking like that? Is it becoming clearer, or dare I say it's a little bit more murky? Let's kick this around a little bit and try and figure out what is happening. We're joined here on set by Justina Lee and John Stepek. John, let's start with you today. What do you think? Beginning of this year, everybody highly certain, knew exactly what was going to happen this year. It was going to be great, wasn't it? Lots of rate cuts, soft landing. Still convinced?
Well, no, not at all. I mean, I think it's probably fairer to say, rather than the outlook this year becoming clearer, it's more that towards the end of last year, markets really got ahead of themselves in terms of optimism. It was always very hard to rationalise why they started pricing in, for example, like 6 rate cuts in the US, or that the Fed would be cutting by March. That always seemed a little bit overexcited, and I think basically over the kind of Christmas holidays, traders have had time to think, actually, wait a minute, what are we doing here? Because this year we've got massive elections everywhere. We've also seen escalation in the Middle East, which everyone was hoping wouldn't happen, and maybe that's not going to get worse from here, but it could certainly get worse from here. So there's an awful lot of politics, and obviously there's always politics, but it feels as if there's a lot more moving parts even than normal in 2024. So I think if anyone's sure about what's going to happen this year, then they're deluding themselves.
Okay, they were sobering up over Christmas. Justina, what do you think?
Yeah, I think it's absolutely confusing. I mean, there was a moment today when I was looking at the Bloomberg terminal, and there was one story that was like economists expecting 4 rate cuts from the ECB this year, and the next one was like ECB's Holzman says no one is even thinking about rate cuts this year. So I think that just kind of tells you the divergence here between like a lot of policymakers and what markets are pricing in. And one interesting thing that Holzman kind of pointed out was that, you know, I think he made it very clear that the tolerance for inflation or any lingering threats of that is just simply not there, especially now that you also have geopolitical risk coming in and potentially disrupting the supply chain and maybe bringing in a lot of the inflationary risks that we thought were kind of like done and dusted.
And you look at what's happening with strikes, you look at what's happening in the wage negotiations, there's still quite punchy wage negotiations coming through, which is clearly upsetting central banks. I hear what you're saying, but what's happening in markets tells a different story. If I just looked at my Bloomberg terminal and looked at what is happening with asset prices, there's not been that much of a wrinkle emerging thus far. Bond markets have changed a little bit. Equity markets have softened up a little bit from the exuberance of at the end of last year. Why are the markets still on track for 6 rate cuts out of the Federal Reserve? Why are they still on track for potentially fresh record highs when it comes to equities? Why is none of that kind of inflation angst being priced back in?
Well, I think that if you're the kind of person who believes there will be 6 rate cuts, there is selectively some evidence, like maybe you're pointing to last week's U.S. producer price data. But I am a bit baffled because at the same time, if you look at CPI, you look at a lot of other sources of data, it definitely does not point to, you know, inflation is over, recession is coming. Maybe the story is a bit different in Europe. And I think in equities, maybe there's a different story there because I think especially if you look at like U.S. benchmarks, the story is, you know, do we still have faith in the mega caps? Can they keep rallying from here despite these valuations? And I think maybe that's a bit of a different story from the economic one.
The problem with 2024, John, is that even if you get it right, for quite a long period of time, you could be getting it wrong. Yeah. So you're going to have to have quite a strong constitution this year, even if you are right.
Yeah, well, I mean, this is the problem. It's one of those things you might have good guesses about what's going to happen next, but it's like, well, how do you play those things in the markets? And this is the problem with trying to do the whole crystal ball thing, and this is why we have diversified portfolios, obviously. But I think the fact that it's interesting because, as you say about inflation, you know, there's been a lot of pushback from central bankers, but at the same time, you know, the kind of demand for European bond issuance this year from governments has been massive. Yeah, it's kind of hit record levels, and you're kind of like, well, this isn't given that, you know, people are starting to worry about the level of sovereign debt and the kind of deluge that we're going to see hit the market. Again, that's not being priced into the market at all. So it's just very interesting. There's this almost kind of belief in Goldilocks still happening, but it still feels as if there are so many things that could derail Goldilocks this year. And I think that's possibly why central banks have been pushing back against it, to, you know, try and introduce a little bit more of a sense of two-way risk. Reality. Yeah, exactly, two-way risk.
So how are the markets going to deal with this? Are we starting to get an idea of that? Because it does seem as if we are looking at a year of extreme volatility. We are looking at right positions being wrong for a while and wrong positions being right. It's obviously your own perception as to whether those are the wrong or right positions. But are we already? What I'm surprised at is we haven't seen a pickup in volatility. We haven't seen options being priced for some of some of these extreme positions. I'm wondering what the psychology is in markets right now. Are people convinced of their own positions, therefore they feel they don't need to hedge? Or is hedging starting to pick up? And if hedging starts to pick up, does that become a self-fulfilling prophecy as well? I'm wondering what's going on below the surface.
Yeah, the options market is interesting because we've seen volatility quite depressed for more than a year now. And part of that seems to be more for structural reasons. Like there's a lot of interest now in selling options instead of buying options. And what this certainly means is that if you do want to hedge right now, this is actually a really cheap time to enter into those positions. But I think, you know, on a macro level, it's kind of interesting because the equity market seems pretty confident in this Goldilocks narrative. Yep. But if you look at what the bond market is pricing in, I mean, we're not just talking about, you know, easing to kind of get back to maybe slightly looser levels. It's like a full-on recession. Yeah. And I think maybe the first place to look is not necessarily the mega caps, but like what cyclical shares are doing.
So what are they doing? What I'm trying to discern at the moment is where people's uncertainty is showing up. Because at the moment, if you look at the bond markets, if you look at the equity markets, there seems to be a huge degree of uncertainty. So and I'm not seeing it in the options market. So if people are starting to get more uncertain about the outlook for 2024, where do I look for that?
Yeah, I think that's a kind of a great question, and we're not really kind of seeing that right now. And maybe that's because there haven't been kind of like these huge kind of swing factors that are like changing people's position right now. But we are kind of starting to see a lot of earnings estimates, you know, especially in Europe, coming down, and that would be kind of interesting because on sort of a top-down level, it doesn't seem like people are that pessimistic.
Where would you look, John? Where would you, if you were looking for uncertainty to show up? Is it in company earnings expectations? Multiples have expanded a lot. We need to see earnings filling that gap. Does it show up there? It's not showing up in options. Does it show up in commodity? Where does uncertainty appear these days? Because 60-40 is producing great returns, but it shouldn't be.
I mean, I think that's the kind of $1 trillion question. I mean, I think one place I always tend to look actually is gold for a start. Okay. I mean, like I said, gold is still hanging around it, kind of near record highs, but not quite getting above it. And to me, that kind of works quite well because it's an alternative asset that's fairly well known. And you would think that if people have got a lot of faith that interest rates and inflation are going to fall hard, then gold shouldn't really be near a record high. Other places, I mean, oil is astonishing at the moment to me. You know, it's kind of been hanging around at $70 a barrel, $80 a barrel in Brent for most of the past year, despite all the kind of volatility, despite issues in the Middle East, despite, you know, the best efforts of kind of Saudi to keep the price propped up or moving higher. So I think that's another one that is almost like a dog that hasn't barked. So to be honest, this year I probably would be looking at commodity prices more than anything else. But it's...
I find it unnerving that there isn't...
It's too quiet. Yes.
It is almost too quiet out there. Everyone, and I don't know whether that's it because everybody is basically like a rabbit in the headlights.
Well, there may be an element of paralysis about it because it really is... I mean, I don't know about you just saying, but I don't feel that there's a high conviction trade because on the one hand, it's like, you know, US equities, the Magnificent Seven were kind of very kind of fully priced. Most other equities are kind of cheapish. Bonds clearly are kind of re-attracting a bid again. But is that because people have just got into the habit of buying bonds over the last, 10 to 40 years of a bull market, and they're keen to buy the dip again, or what they think is the dip? So I think there's just an awful lot of views kind of competing for attention.
And
really.
Just very briefly, rabbits in the headlights, or is this a market that has conviction?
No, I'm worried we've just kind of jinxed it there. But yeah, I think, one trade is, I mean, if you think the market is over-optimistic about rate cuts, I mean, are you supposed to kind of use short bonds from here? A really active area, I mean, we were talking about how boring equity volatility is, but like rates volatility, that market has become a lot more active. So that's another area where you can place trades. I would also be interested in seeing like the internal kind of like leaderboard within the stock market. Like, are people so kind of risk tolerant at this point? Are they kind of buying the risky stocks? Are they buying cyclicals, or is it just that they want to ride the mega caps?
Okay, so look for maybe some rotation amongst those sort of cyclical defensive stocks. Guys, that was great. Honestly, I'm slightly unnerved by what is happening here at the moment. Justina Lee, John Stefak, thank you very much indeed. Coming up, more insights into our question of the day. Is the outlook for 2024 becoming clearer or maybe a little bit more murky? Steve Sosnick, Interactive Brokers Chief Strategist, joining us next. This is Bloomberg.
All this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time where we'll be fully transparent on viewing data.
What we expect for this year compared to last year, that inflation will be half of the level of last year. This is good news per se, but as I said, inflation is too high. So for me, all the discussions regarding inflation cuts, this comes too early.
Joachim Nagel, President of the Bundesbank, a hawk, to say the least. Talking, though, about rate cuts, I'm trying to think about how I should think about Nagel today, because you've got Holtzman saying maybe we shouldn't think about rate cuts at all. Nagel's kind of saying maybe we will. Maybe we're a bit early in terms of our pricing, but maybe we'll actually get them. But again, it just paints a picture of confusion at the moment. When do these rate cuts come? Do they come at all? How big are the rate cuts going to ultimately be? We came into this year, as I keep saying, convinced that we were going to see multiple rate cuts, we were going to see a soft landing. All was good. 15 days in, what do we think? Is the outcome for 2024 becoming clearer or maybe a little bit more murky? Joining us now with an answer to that question, Steve Solznick, Interactive Brokers Chief Strategist. Steve, what do you think? Beginning of this year, we knew what was happening. 15 days in, how convinced are we?
Good afternoon, Guy. I think it's very tough. I think the market's in some ways really, I'm not going to say delusional, but I think sort of wishful thinking is really going on. We ended the year with what I like to call weaponized FOMO, where basically any asset that could have been bought was bought because it was this huge race in, not to miss benchmarks, and for institutional portfolio managers to do their best either to perform on absolute terms or on relative terms. Well, obviously that catalyst is behind us, but a lot of the features that were priced in late December remain with us. And it's very tough as you have an election year in the U.S. that promises to be, bizarre. And then you have the conundrum of equities pricing in solid earnings growth, while at the same time the bond market is telling us we're getting 6 rate cuts. Those are conflicting economic scenarios. So there's a lot that has to be resolved this year. And unfortunately, the outlook, I think, is quite murky and remains so.
When do you get resolution to that? How long are we going to have to wait? And when that resolution comes, how messy is it going to be, do you think? Because as you say, you've got so many conflicting forces in the market right now. The bond market is one way, the equity market is the other. We've got very little kind of protection being bought in the equity market. The volatility in the bond market has been extreme. How lumpy and bumpy will that process of resolution of some of this tension be, do you think?
I think there will be some bumps in the road. There have to be. I think we're going to start to figure this out within the next couple of weeks. It's earnings season, and we're going to start to have companies be able to tell us, are the expectations for 2024 too high or too low? And you're going to have a Fed meeting coming in a couple of weeks, and we'll see if Powell pushes back. He hasn't pushed back on anything since. He's really said whatever the markets wanted to hear at his press conferences and then let everybody else push back. But the community doesn't want to hear from the supporting cast. They only want to hear from the star. But I think these are the things that might give us some clarity as we go forward. Also, realize for better or worse, you're used to a parliamentary system. Our election season really comes into play today, the Iowa caucuses. And so we'll see, how much of how much of an impact the potential Trump-Biden race has on things, which is likely to be rocky, shall we say.
How big an impact do you think that's going to have? I keep being told by people, Steve, let's just talk about politics for a moment. I keep being told by people, don't worry about pricing in the election till we get really close to it, i.e. September, October, November, maybe we start to think about pricing in the election. Do you think it's going to be earlier this time round?
I do, because I think you have, you have a candidate who is sort of volatility personified, and you have another candidate who is sort of, there's a lot of question marks about the president that get raised, rightly or wrongly, and so I think you're going to get a lot of swings because these are older men, one of whom is basically appearing in court on a constant basis. These are all reasons for volatility, yet around the election, I should say. But yet, while we do see the VIX futures curve pricing in some volatility for later in the year, which I do think is understandable, in the short term, nobody really wants to face it.
Let's go from politics to geopolitics. Do you think investors are being complacent there as well? We've got the US advising ships to avoid the Red Sea once again today, we understand. We understand that another vessel potentially has been hit. Obviously, all this reporting confusing coming out of this region, but the UK Navy gets the report of an incident 95 nautical miles south of East Aden in the Yemen area. This is really difficult to deal with, but it's going to have a material impact in terms of inflation, in terms of supply chains. How do markets fold that in without seeing a lot of volatility, or do you just ignore it and just assume that it's going to be resolved?
Sadly, the latter. I've always said for years that in markets, traders, particularly investors specifically, and markets in general, are lousy at geopolitics. Investors, let's say equity investors, are very good at understanding the things that impact the bottom line of the companies they invest in. How does it affect earnings? How does it affect cash flows? How does it affect revenues? When you start to get into geopolitical issues, particularly in sort of corners of the world that are a little less understood, investors tend to punt on that kind of thing. And I know that sounds nuts, especially when you're talking about a key region of the world where a lot of shipping goes through and where a lot of the oil transit can potentially go through. But yet somehow we're ignoring it. The message that may be being told to us from the oil markets is that the demand just isn't there, so it doesn't even matter that there might be supply hiccups. So, but in the near term, I think investors prefer to look past it unless there's something very specific that affects the companies they're investing in.
Yep. Tough place to be this year, I think, for investors. Steve, great to catch up. Enjoy the rest of the day. Thanks for stopping by on the holiday. Steve Sosnick, Interactive Brokers Chief Strategist. Still ahead, we want to talk about another source of volatility, this time coming from Boeing. The company very much remains in crisis mode. It faces an extensive inspection review from the FAA. It's opening its doors to further inspections. That has been announced today. What next for this troubled company? We'll discuss it next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time
to be in this role, it's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
So China's aviation regulator has now once again temporarily halted the restart of 737 MAX jet deliveries. This, of course, as Boeing grapples with safety issues on the aircraft, particularly the MAX 9. The company is now looking to regain trust as it tries to build reliable aircraft. Obviously, we've had a number of issues with this airplane, this airframe. The 737 MAX started with the 2 crashes and has been a struggle ever since. What happened with the Alaska flight has made life even more difficult. So over the weekend, Benedict Camel, the rest of the aviation team, put together a fantastic big take on what is happening here. I read it first thing twice. I would urge everybody to read it. Benny's here now to talk about kind of what is happening and trying to pull it all together, this story for us surrounding Boeing. Benny, let's talk a little bit about where Boeing is right now. We're in a situation where we're all trying to cover what is going on at Boeing. Boeing is trying to be transparent. But ultimately, the only way that it's going to recover its reputation is over a long period of time with a lot of transparency and an unblemished safety record. Where are they starting from in terms of that journey? And where are they starting from? And what does it tell us about how long that process could take?
Yeah, I think the key thing is it's going to be a long-term journey, and where they're starting now is, we're barely a week into, just about a week after this accident on the Alaska airplane, and what they can do at this point is work through the immediate aftermath, the immediate shock of this accident, and what they've done is they've put in some extra checks. They're deepening the inspections at the company, but also at Spirit. They're inviting suppliers and customers to come in and review their own processes. We know that the FAA is taking a very close look at them, and they might have a third party come in as well. So if you stagger this in sort of 3 phases, the immediate, the midterm, and the long term, we're still very much in the immediate aftermath of this, and management is trying to sort of get to grips with it. The safety committee, which was set up after the MAX crashes almost 5 years ago, that's basically the group that is very much in charge at this point. And Dave Calhoun, the CEO, has made that very clear. He's messaging, fairly aggressively in terms of sort of his presence to the staff. But at the same time, he's made clear that right now this is not about selling planes. This is not about sort of our metrics. This is not about our goals. This is about safety and safety first.
Okay, let's assume that that's a relatively long-term process, that takes a while. Is what we're hearing that basically Boeing is going to have to put safety before profitability? In fact, can it make money while it does this? And is even making money does it undermine the case around being safe? I'm just wondering if these two things are so antagonistic at the moment that it's possible to actually have both. Very briefly, Benny.
Well, that is the big conundrum for them, and they've been there before. If you remember the long-term grounding on the 737, and they're basically going through that again now. Can they get these two things together? And it's unclear.
Benny, sorry to rush you at the end there. My fault. Benedict Camel, heading our aviation team. Some fantastic coverage coming out on this Boeing story. This is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We are telling the international community that between democracy and authoritarianism, we will stand on the side of democracy.
Lai Ching-te of Taiwan's still ruling Democratic Progressive Party, the DPP, speaking after winning the presidential election this weekend. You could argue that victory deals something of a blow to Beijing's ambitions to have greater influence over the island. But the fact that there wasn't a majority, you could argue, actually maybe maintains the status quo and gives China something to work with. Amy Selico, principal and co-head of the China practice at the Albright Stonebridge Group, joins us now to discuss. Amy, if the victory had been more convincing, China might have had a problem, but it wasn't. So I'm wondering if the fact that the DPP won but didn't get a majority is something that China can live with. And in so many ways, therefore, this becomes a status quo, everybody wins kind of a scenario.
I agree with you, Guy. I don't think the Chinese will ever admit it, but actually there is some good news, even for Beijing, with this unprecedented third-term victory for the DPP in maintaining the presidency on Taiwan. They, as everybody knows, lost seats in the legislature, so they don't have a majority there. It means they have to work with the two other opposition parties. The TPP, the newest party, had a real decisive victory in actually mattering. This is the traditional anti-establishment party on Taiwan. And so democracy is working among Taiwan's 23 million voters in a way that, while of course Beijing is not going to celebrate that victory, is, as you said, going to maintain a status quo that is good for all of us in seeing stability in the Taiwan Strait. And we've seen that already by Beijing not taking any provocative military actions in the wake of Lai's victory on Saturday.
How do you think this changes the relationship with the United States? China can live with this. Taiwan has been slowly pivoting towards the United States. Does this slow that pivot down?
I think that the United States has been really careful, the Biden administration, in making sure that they were congratulating the incoming Lai administration on its victory, but not provoking any side or giving any indication that this was going to result in a warmer relationship with the United States. Like with the players in the region, it signals a maintenance of the status quo. President Biden's first words when asked about the victory was saying the United States does not support Taiwan independence. Secretary Blinken's congratulatory note to the Taiwan authorities did signal a maintaining of the status quo and an unofficial relationship with the authorities in Taiwan. And all of that was meant not to provoke Beijing. And so we do have to see all sides, including William Lai, in accepting victory on Taiwan. Nobody was seeming to try to provoke the situation right now. So I think U.S.-Taiwan relations, Steve Hadley, former national security advisor, saying that relationship is rock solid in his unofficial trip to Beijing, to Taiwan over the weekend. And so really symbolizing just the maintenance of the status quo.
So if you're an investor and you're thinking about how the world works right now and you're thinking about the global technology sector, is it also a continuation of what we've got now? Is it a continuation of the status quo when it comes to tech?
Well, I think there's going to continue to be uncertainty on both sides of the Taiwan Strait just because of a continuation of tension. So I don't want to paint, an overly rosy view in the short term because investors, whether they're in the technology sector or any sector investing in the Indo-Pacific, has to watch this situation very carefully. But right now, all three sides of this triangle that we're always concerned about in Taipei, in Beijing, and in Washington, D.C., nobody's trying to instigate more instability. That is good for investors. But let's look for the next milestones here. The May 20th inauguration, and of course, in the lead up to that, whether and how Beijing and Washington signal any changes. I don't think either party wants to unless provoked. And then, of course, from Beijing's perspective, what happens here in the United States in November matters to that cross-strait relationship and U.S.-China relations as well. So investors...
Okay. So you bring up... So you bring up the U.S. election. So let's talk about it through that lens. Do you think either party, regardless of who wins in November, is going to change this policy of persuading tech companies to invest in more productive capacity in the United States? We've seen the CHIPS Act coming from the Biden administration. Were the Republicans to win, do you think we would see a continuation of that?
I think we will. I think there's a lot of bipartisan support. We already see it in Congress. Of course, the legislation was passed for that CHIPS and Science Act on a bipartisan basis to reinforce investment here in the United States. And so I absolutely believe that would continue whether President Biden is reelected or the Republican candidate is elected in November. So I think that is some stability for investors and seeing the United States wants to be a hub for technology investment. In some ways, that is about the tense relationship with China, but in other ways, it's just about reinforcing American competitiveness in global markets.
Yeah. The final question, and coming this from the Beijing sort of perspective, the Chinese economy continues to struggle. We continue to look for stimulus, but it doesn't come. Is Taiwan should I be thinking about Taiwan risk in that light? If the Chinese economy doesn't recover, will the Chinese authorities take a different, maybe less benign view towards what is happening in Taiwan? So I'm wondering how the economic backdrop in China over the next few years may alter the course of its approach to this story.
Yeah, I think Beijing is firmly in the driver's seat to take one of two courses that you're asking about. Does a slower Chinese economic development story lead China's leader Xi Jinping to pursue, more instability on another topic, taking domestic attention away from the economy? That's a possibility, but I have to say I think the alternative course is the more likely one, and that is if China continues to work on economic rebuilding, that means they don't want to see instability in the surrounding areas. And so they don't want to see any kind of activity in the Taiwan Strait that would decrease the potential for China's economy to stabilize, as of course any kind of conflict would. And so I lean towards the view that pragmatism will prevail for the Chinese government unless provoked. And that's the big question mark, unless provoked, would not seek preemptively to just distract from a weak economy by taking any kind of action vis-a-vis Taiwan.
Jim. Amy, a really interesting way to start the year, such a critical election. So many elections this year, and this one could prove to be so important in terms of establishing maybe some stability early on. Amy Selico of the Albright Stonebridge Group, thank you very much indeed. Thanks for stopping by on this holiday in the United States. Up next, we'll actually talk about an area of geopolitics that is significantly less stable. More tension in the Red Sea. Houthi attacks on shipping continue. We've got U.S. authorities, we understand, warning shipping off the supply chain route through the Red Sea. We'll talk about what this means for inflation, etc. next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges. Wilson's next.
It was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Right, let's talk about one of the stories that certainly could be driving inflation concerns this year, tensions in the Red Sea. Attacks on commercial vessels by Houthi militants still ongoing, already having an impact on certainly shipping costs, bleeding through now into what is happening with energy costs as well. And according to the European Economy Commissioner, Paolo Gentiloni, this is going to be something that we need to pay a great deal of attention to. Joining us now for more is Bloomberg opinion columnist Mark Champion. Let's start off with dealing with the Red Sea. So we've seen a series of attacks by the US and its allies designed to degrade the Houthis' ability to target ships. yet it looks like we've had another attack on a ship. This is incredibly asymmetric. Very hard to stop a small, nimble force attacking these ships. Are we starting to see this metastasizing now? Is this becoming clearer what ultimately the medium term is going to look like in this region?
I don't think we have clarity yet, but you're absolutely right that it is asymmetric and therefore very, very difficult for the U.S. to control. So, the U.S. was clearly reluctant to hit, the Houthis on land. Eventually they felt they had to. Even now they say that they hope that they've, degraded maybe 20% of the Houthi missile capability with the strike, which was quite a large strike. But it's very clear that the Houthis are pretty resilient. They're a militia. The Saudis spent almost a decade trying to, pin them down, wipe out their arms depots and all these kinds of things, and failed. You're absolutely right. Asymmetric is the problem. They have to hit one ship, one oil tanker. The U.S. has to prevent, every missile. And the U.S. and its allies, obviously, including the U.K. It's extraordinarily difficult to manage.
Does that give us any clues as to how long this will last for? Is this the new reality? I'm struggling to see what the exit looks like.
Well, the Houthis say that this is all about Gaza. There's good reason.